In this presentation, we will discuss a job cost system, the accounting for a job cost system. This will be a long presentation. If you would like to jump to relevant points within it, take a look at the description below, which will have links to those relevant points as well as a discussion of what will be included within them. If you would like to see this in playlist format, we'll also have links to a playlist format, and we'll have links to related accounting topics. In this presentation, we will introduce the topic of managerial accounting. When considering managerial accounting, we can compare it to the other major form of accounting, which is financial accounting. There will be overlap between managerial accounting and financial accounting, but the major difference when we consider managerial accounting is that our main focus is for management. Our main focus is for management's use, management's goal to make decision-making for the company. So managerial accounting is geared towards decision-making processes, making reports for management. If we contrast that to financial accounting is the creation of the financial statements ultimately. We're entering data, we're going to create the financial statements, the balance sheet, the income statement, the statement of equity, and we could use that by management. However, the primary goal and the way it is constructed is actually for external users. So when we make the financial statements, when we think about financial accounting, everything that we put together is really geared towards the eyes and the objectives and the goals of external users, people like investors, people like creditors. They're not designed necessarily or ultimately solely for the primary purpose being the management. Usually when we think about this, we think, hey, wait a second, the financial statements are basically all of the financial data. So wouldn't management need to be using the same income statement, balance sheet, statement of equity when making decisions as would be the external users? And the answer is yes, the management will be using that information. The financial data that we're putting together will be used for the managerial accounting as well. But the managerial accounting isn't restricted in the same way as we are with the financial statement reports, because the financial statement reports are really geared to, and there's going to be restrictions on in terms of regulatory restrictions, so that the financial statements are proper and for the best use of is the goal for external users. So although they're going to be the same financial data for the managerial accounting, we can do other things with it outside of just the norm of the financial statements. We can customize them, in other words, make custom reports for management, for decision-making processes. So everything that's going to flow forward in terms of what's the difference between managerial accounting and financial accounting will gear back to this answer. It seems fundamental, it seems basic, but everything stems from this, and that is that managerial accounting is for management. It's for internal users as opposed to external users. It's for the decision-making processes for that management to make decisions about future decisions, as opposed to external users to make sure that they have the information they know they need, typically for investment decisions or credit type decisions. So given that managerial accounting is for management, let's think of some of the differences. And it's always useful to think about the differences in contrasting the financial accounting versus managerial accounting. So who are the users for financial accounting and managerial accounting? The users are going to be external for the financial accounting. Managerial accounting are going to be internal. And again, that's the major focus. The financial accounting, although we use the same information, the information is designed and put together in such a way and regulated to be put in together in such a way so that external users can trust it, be able to know exactly what's going to be expected from it, and be able to use those external users being investors, creditors. In the managerial accounting, we're talking about internal users. So we don't have that same problem of the internal users trying to, print reports that might be deceptive to themselves or anything like that. And therefore, management can print their internal reports in more of a free way, however they want to create the reports or put the numbers in order to make the best decisions. So most of the differences between these two types of accounting will fall into alignment with this major difference here. Who are we focused on, internal users or external users? Then we have the reason for the accounting. The external decision making in terms of financial accounting is what we're putting this together for. So we're looking for the external users, investors, creditors. They want to make investment decisions. Should they put their money into the business? Should they invest in the stock? Should a bank loan money to the organization? Those things they need, in order to make those decisions, they need some financial statements that they can rely on, numbers they can rely on, and those numbers need to be based on what they want to know. Big picture, typically the full company. How's the company doing as a whole? Managerial accounting is going to be focused on managerial planning type decisions. So that means that the whole purpose is to really take that information and put into a plan for the future. Now, note that there is overlap, of course, because if I'm thinking about investing in a company, I might do my own kind of projections and try to think about what are they going to do in the future. Do they have a good plan? Is it going to be a good plan? However, really the investors are trying to see where a company stands at this point in time. It might not be getting so much into the nitty-gritty as managerial accounting may do to take these numbers and use them to make more detailed projections, especially about a piecemeal, piece by piece, unit by unit, area by area, department by department of the company. And then we got flexibility. The financial accounting is going to be limited by regulations and generally accepted accounting principles in the US. Typically, there's going to be limitations, and the reasons for those is because these external users need to know what they're getting. They need some form of standardization so that they can compare this company's financials to other companies' financials. And therefore, financial accounting is going to be much more standardized. It's got to be in order to build trust with the public. If we're trying to get investments from the public, then we have to be in alignment with standards that the public can expect so that they can read what we're giving to them and be able to compare and contrast what's being given with other companies. So when we think about the financial statements, then we know exactly what to expect for the most part because it's regulated. We have a standardized format, and we have to have that standardized format in order to make these comparisons, in order to make trade and investment and transactions as easy as possible. The managerial accounting, however, is not limited in the same way. Why? Because we're not giving these reports to anybody outside the company. They're internal reports. They're us inner working, trying to make the internal decisions. So we might be making reports about a small group, a small unit. We might be making reports about some type of product or something like that, one product out of many. In order to make those types of decisions, we could format the reports in any way we want because we're not giving them to external users who are then relying on them to make decisions. So we have a lot more flexibility for that reason for managerial accounting to run reports, to make reports, to think about, what can we do in order to make the best decisions and what kind of data do we need in order to do that. The availability of the data. Financial accounting is typically going to be, if it's a publicly traded company in particular, it's going to go through an audit. We're not going to have the data possibly quarterly or yearly. We have to wait through that audit process to take place for them to really be finalized, to have those financial statements. So it could be a very set process on when we're going to get those numbers, and the numbers might not be finalized, of course, for a little bit of time after the period has ended. Whereas managerial accounting, and that of course deals with regulations. We have to go through the regulations. We got to make sure that everything is set up in accordance with rules and regulations, especially if it's a publicly traded company. Do these financial statements align with generally accepted accounting principles and whatnot? That process is going to take time for financial accounting, and it's very regulated. For managerial accounting, we don't have that same kind of regulation. We have limits, of course, but those limits are typically going to be, what can we do? So for managerial accounting, the question is often a cost-benefit analysis. We could get this more information. The question is it worth it for us to get the more information? There's always a balancing question of, is it worth us to put in the time to get more detailed information? Or is the better decision that we can probably make with that more detailed information not worth the added cost? That's typically the type of decision-making restraints that we have on managerial accounting, as opposed to the types of regulatory restraints. So if we want to put numbers together, if we want to put reports together, if we want to analyze whatever we want to analyze internally, no problem, except that it costs money to do so, And we want to make a cost-benefit analysis to decide whether or not the time spent is worth the effort, as opposed to conforming to regulations, as is typically going to be what we're going to do with financial accounting. The time focus for the financial accounting is typically going to be past. We're looking into the past. In other words, we're looking at historical data. Now, of course, investors and are going to be looking to project into the future as well, but all the financial statement preparation is geared towards what happened in the past. From our side, from putting the stuff together from a company side, we're trying to just say, hey, what happened, and put it together as accurately as possible. And then the investors could make future projections based on that. Managerial accounting, when we put this information together, it usually has a future focus. So we're trying to focus on future decision making. So when we put together reports, internal reports, whatever we need to do from an internal standpoint, we're typically thinking about what can we do for the future in this place so that we can increase production. If we look at the information focus, it's going to be on the entire organization for financial accounting. We're looking for information that's going to affect the entire organization. And that's by design. The financial statements are there for the entire organization because investors and creditors are typically worried about the entire organization. They're not really looking into the detail. They're not looking at segments of the organization. Some will, but for the most part, the reporting is going to give a whole. What do things look like as an entire? On a managerial accounting, we're typically going to go more into detail. We're going to look at the department by department. We're going to look at product by product and try to make those decisions. So typically, financial accounting is looking big picture. How do we stand overall? Whereas managerial accounting is going to go down into more of the nitty gritty and try to figure out what can we do from a piece by piece standpoint to improve operations. Nature of information. Financial accounting is going to be purely monetary. So remember that, of course, the balance sheet is going to have things like equipment on it and this stuff and stuff that's not money in and of itself. Equipment could be a forklift or something. But when we put on the financial statement, we report it in terms of dollars. Everything is reported in terms of dollars. And of course, that same information will be used in managerial accounting, but it's not the only type of information. We recognize that that's only one set of information. If we can put numbers to something, we typically will, because that makes things a lot easier to compare and contrast if we have numbers to them. But oftentimes we may not have numbers. The numbers may not be representing monetary amounts. We might be having to compare other types of things, time or other types of things. And we could have other things that are completely non-numeric that we're comparing. We might have to actually compare different types of data, actually just reviews or something like that, and try to make managerial decision-making processes based on that. So again, we typically will break things down to a monetary basis if possible, break things down to a numeric basis if possible, because that's better for making comparisons or easier to make comparisons. But we're also going to use any type of data that we can to increase decision-making processes. In this presentation, we will take a look at cost classifications. There's a few different ways that we can classify costs, and they all have their pros and cons, their benefits to classification in different ways. We're going to classify costs here by behavior. Now you may think, what does that mean? Do costs have behavior? And we could say, well, yeah, costs do have behavior in that they act in certain ways in relation to other activities. We're going to classify the two types of costs here being fixed costs and variable costs. This type of classification is not included in financial accounting. So if you're going from financial accounting to managerial accounting, this is going to be a new concept. And the reason we're going to have cost classifications by behavior is that it really helps with projection. So we have to have this because when we're looking into the future, it's really going to be helpful if we can determine how costs act so that we can make projections based on different levels of production. So we have fixed costs. Fixed costs mean that as production level rises, the cost remains fixed. So for example, if we have the activity down here, we'll say this is production if we're making units of something. As we make more units of something, the cost total remains the same. Remember here that we're talking about total cost, not cost per unit. We're starting here with total cost. So, for example, if we're saying that the rent is going to be $1,000 a month, then it really doesn't matter how many units we make. If we're producing things in a warehouse and we make 1 unit in that warehouse, then it still costs $1,000. If we are producing in that warehouse and we make, say, 100 things, the rent still is $1,000. If we keep producing in that warehouse and we maximize the production of the warehouse, let's say it's 5,000 things, well, then units of production, whatever we make, then it's still going to cost us $1,000. No matter what we do, the rent is going to be the same. And so if you look at that in terms of the fixed cost, you're going to say, well, it's going to be what it is no matter what. So when making projections, then we can think of, okay, how many units do we have to produce in order to pay off the rent, pay off the fixed cost? So the other types of behavior that we're going to have, the major second group that we're going to have, and we're going to try to basically break everything out into these 2 groups, even though it's not possible or not all costs fit nicely into these 2 groups. We would really like it if they did, because that would simplify the world here. And we're going to try to do so that we can make accurate projections. And so the other type is variable costs. And variable costs are going to go up with each new unit of production. So for example, if we're making guitars and this is the cost of wood, the total cost of wood, and this is the activity, how many guitars we're going to make. Well, if we make 1 guitar, then it's going to cost, or if we make 1 guitar here, it's going to cost so much. And then if we make 2 guitars, well, the activity went up and the cost is going to go up in proportion. It's going to be a straight line because the cost is going to go up with the same number of units. Let's say the cost is for wood that's going to go in the guitar. If we make 3 guitars, well, then the cost of wood is going to go up in proportion to the number of guitars that we're making. So wood or direct material that goes into the cost of production is going to go up at a constant rate, and as opposed to something that is fixed, such as the rent. If we know those 2 things, then it's really useful for us to then make projections into the future, because now we can say, okay, how many guitars do we need to make in order to, get to this level of cost? And of course, we'll add into this pretty soon. We'll add into it the amount of revenue per guitar we're going to get. And if we take the revenue minus the variable cost, then we can say, okay, how much are we making over the variable cost to see how many units we then need to have in order to clear the rent price. And that's how we start to kind of think about these things. What do we need to produce in order to clear our costs? It's a lot easier to make those types of projections if we can break all costs up by behavior between fixed costs and variable costs. Now, some costs will line up in these 2 very easily, and it won't be a problem. If we're talking about wood in the guitar, then that's probably pretty straightforward. If we're talking about the rent, that's pretty straightforward. But we're going to have some things that aren't quite as easy to go into these 2 components. They may have some combination between fixed cost and variable cost. And what we really want to do is break them out between those 2 for our projection purposes. And we'll talk about different methods that we can do that. That's going to be one of our goals in managerial accounting, is to break everything out between fixed cost and variable cost, that allowing us to make nice projections into the future. Another way that we can classify costs is by function. What does that cost do? Why are we incurring this cost? So we can have direct costs and indirect costs. Direct costs are going to be costs that are traceable to a cost object. So if we're in a production cycle, then direct costs would be things like direct materials and direct labor. These are things that we can trace to a particular unit of inventory that we are producing. So direct materials, we know exactly if we're making guitars, for example, we can trace the wood in the guitar to a particular guitar that we are producing and allocate the cost of that wood to that piece of inventory, to that guitar. If we're talking about direct labor, same thing. If someone's putting together a guitar, we can allocate the cost of the labor that's being put together to a particular piece of inventory, a particular guitar. On the other hand, indirect costs are things that we can't trace, are not traceable to a cost object. So examples of that are going to be maintenance costs for multiple departments, or things like glue, or things that we can't put to a particular guitar. If we're making one guitar, then we can't really have these indirect costs allocated specifically to that guitar. It's going to be indirect. So if we talk about maintenance for multiple departments, then possibly the maintenance is going to be for the entire warehouse, and we can't apply the maintenance, for example, to one particular guitar because we don't know how much to apply to a particular guitar. The production process needs maintenance within the warehouse, but we can't assign it directly to a particular guitar. And we can take that concept to different departments as well. If we pay for maintenance for multiple departments, then the maintenance is there for multiple departments, but it's difficult to allocate to a particular department. And we're going to have to figure out some type of way then to allocate these indirect costs. That's going to be one of the challenges we have. If we have maintenance for multiple departments or multiple units of inventory, how then can we take this information and allocate it to its particular unit, which we don't really know. We have the similar problem if we're talking about small materials like glue or something for a guitar. It might be possible for us to classify glue as a direct material that we can then allocate specifically to a particular guitar that was used in. However, doing so would be not cost effective typically. So if we're talking about something like glue or something like that, then we might have to use some other type of allocation method. We don't know exactly which piece of unit of inventory it was used on, so it's indirect. So we have to find some way then. Our challenge will be to take these indirect costs, these costs that we know need to be allocated in some way in order for us to properly value our inventory, and try to allocate them in some way even though we don't know directly where they apply. And that'll typically be the concept of overhead. So anything, for example, in a factory that we work on will if we can't apply it directly, direct materials or labor, it's probably going to be an indirect cost, something that's going to go into overhead, that we're then going to have to figure out how can we allocate this to our units of inventory to properly allocate the inventory. So if we're talking about depreciation on a warehouse, then that depreciation is part of the cost of making stuff, making the guitars. But how do we allocate it to any particular guitar? We're going to have to figure out how we can make those types of allocations. There's a supervisor in the warehouse that's supervising all the guitars we make. How do we know how much time we should put that supervisor's time on a particular job? We'll have to figure out how we can make those allocations. So that's going to be one of the challenges we'll have as we work through the manufacturing process, as we allocate costs. In this presentation, we will take a look at product costs and period costs. When considering a manufacturing company, we can break out the costs to those costs that are used to create the product, to create the inventory that we will eventually sell, and those that will not. The product costs are going to include costs of direct labor, direct material, and overhead. So we just want to memorize these types of things as the three main categories we will be using when we manufacture inventory, when we make the asset of inventory, when we make the stuff that we're going to sell. That stuff is comprised of not just stuff, meaning not just direct materials. In other words, the creation of something like a guitar that we intend to sell is not composed of just the materials in the guitar, the woods, the strings, and whatnot, but is substantially composed of other things such as labor and overhead. So these are the three things that make up the cost of the guitar that we're going to sell, make up the cost of whatever product it is that we sell. The direct materials are pretty straightforward. This is going to be the material that goes directly into the units of inventory that we're creating. So if we're creating guitars, if we're making guitars, the wood is clearly a direct material that we can assign specifically to inventory, and more specifically to whatever batch of inventory, whatever unit of guitar that we are making. The direct labor is very similar in that we are applying labor directly to a unit of production. So if we're making guitars and we have a custom guitar, let's say, and an individual making that guitar, then the labor that's being put in will be included in that guitar. And again, it's a little bit less conceptual to think about that, the labor is being included in the guitar. It's not physically in the guitar, it's something that's intangible within the guitar. But when we think about the cost of the guitar, it's far more than just the wood that's in the guitar. The cost is primarily the labor that's going to be in the guitar, the thing that converts that wood into something useful, a guitar. So that's going to be the direct labor that we can apply directly. And then we have this bucket of overhead, the most confusing bucket, the bucket we're going to have to do something about something with, and those are going to be things that we cannot apply directly to a specific unit. So or a specific area. So for example, if we're making guitars and we're applying costs directly to a guitar, if we make custom guitars, then things that we can't apply directly might be things like glue, because it's so small that we don't want to apply it directly. It would take too much time for us to apply out the glue to the guitar. So to track the amount of glue we use and whatnot. So what we'll do is we'll put it into overhead, and then we'll find some type of cost allocation to then allocate it out. And that's going to include anything that we can't allocate directly. So if we think about things like overhead in the factory, anything within the factory that we use that we cannot apply directly, pretty much anything other than direct materials or direct labor. Things like the depreciation on the factory, we're going to have to apply that out to the guitars. We need the factory to make the guitars. If we weren't making guitars, we wouldn't have the factory, and therefore wouldn't be depreciating it. And so the cost of that depreciation should be allocated to the guitars, but we want to allocate it specifically to units of guitars if we're using like a job cost system. Things like a supervisor salary. We don't know who the supervisor was supervising at any given time, or how much time was spent supervising one job versus another job. And therefore, we're going to have to allocate that production supervisor to overhead and then figure out some type of allocation method. So the utilities on the factory, same way, the maintenance on the factory. So we're going to have, this is going to be the most challenging of our segments here. So we know it's part of production. That's not a problem. Anything on the factory is part of production. But it becomes challenging to note if we're in a job cost or process cost, what job or what process should this overhead go to? And then we're going to have period costs. Now, the period costs are typically, you can think of them as things that are not going to be part of the production, part of the inventory. These costs up here, direct labor, direct materials, and overhead, are going to be costs, the production costs, are going to be costs that we're going to use to create the product. And therefore, they're going to be capitalized when we use them. And this will seem a little unusual if you're used to looking at a service company, because when we do something like pay wages, for example, we're pretty much used to just saying it's going to be a wages expense. And in here, we're going to put it as part of the inventory, an asset. When we use materials, we might think of it as a materials expense. We're going to capitalize it as an asset. When we do things such as overhead, depreciation, and things like that, we're used to saying depreciation expense and expense. But here we're going to capitalize it because it's part of the product that we're going to make. When are we going to expense it? When we sell the product. The period costs, on the other hand, are going to be costs that are not related to the production of the product. And they're going to act more typically as we would think when we're dealing with like a service type company. They're going to be costs for a particular time period. And they're typically broken out between two items, selling and administrative. And they act like we would think for a service type company. So if we're talking about the executive salary, anything that's not in the warehouse, anything that's not in the production area, which will be very distinct in like a book problem, we'd have to separate that and separate what's in production and what's not. If we're talking about the corporate office that's not in the production, anything in there will probably act very similar as to a service company, meaning if we pay the salary of administrative staff or the accounting staff, then that's going to be done during the period because the cost was incurred during that period. We paid people in order to do the job that time period. The matching principle would then allow us to expense it at the point in time that basically the wages happen for the most part. The utilities on the executive office, unlike the utilities on the production, on the factory, which would go into overhead, if it was utilities bill on the office, the executive office, we would expense it like we would typically think. If we're talking about depreciation, if it was depreciation on the executive office, we would depreciate the expense. If it was on the factory, we would include it in, once again, the inventory in some way. So these selling and administrative expenses are typically going to act a little bit more like we would think if we're used to having dealt with companies that aren't production companies, that don't deal with making inventory, companies that either buy or sell inventory, or companies that are service companies. As you would imagine, most of our time here is going to be up here in the production cost to make the product. One, because that's the most interesting part, because that's where we have to, all the activities happening within a manufacturing company, that we have to track all this stuff. And two, because that's going to be something that's different than other types of industries. Therefore, that's where we want to focus our time. If we look at some examples of the type of classifications we've had so far, we had variable cost versus fixed cost, direct or indirect cost, and product or period costs. So if we think, let's look at some examples and think about where they would go in these cost allocations. And again, when we first learn this stuff, some people probably learn a few of these allocations better than others. It's important for us to know all of them. So the variable cost versus fixed cost, the behavior that we're going to have between the cost of direct or indirect. Can we apply the cost out to a particular unit, a particular function? And a product cost or period cost really is dealing with, are we dealing with the inventory stuff and that's making the inventory, or are we dealing with non-inventory stuff, which is basically administrative and selling? So let's take a look at wood. We're going to make guitars up here. So if we have wood, and this is a wood guitar, you can see here. So if it's a wood guitar, we would say it's typically going to be variable, because every time we make a new guitar, we're going to have a fixed number of increase in wood cost, you would think. And so that's going to be a variable cost as opposed to fixed. It's going to be direct typically, because if we're making custom guitars, we would know exactly which guitar that wood goes to. We would be able to assign the guitar out directly. And the product or period, it's going to be clearly a product cost, because the wood is going to be for the production of the guitar. If we have direct wages, someone actually making the guitar, we're paying someone to make the guitar, it once again will be variable, because if we make two guitars, we would expect the wages to go up at some variable rate. If we have direct or indirect, we're going to say it's direct, because that person, we can apply their cost directly to whatever guitars they work on. And then the product or period, it's clearly a product cost, because we're working on the production, the cost of those wages. And again, that's something different, because then when we actually record the journal entry and we say, instead of wages expense, we're going to debit the guitar, we're going to debit like work in process inventory of some kind. We'll talk more about that later. And then that's going to be unusual at first, because a lot of times when we go through just memorizing transactions, we think of wages as an expense just automatically without knowing the rule so much, or applying the rule. Same with like utilities. We're going to have utilities, not utilities expense, the debit, but go into some type of asset for the inventory. That's going to feel unusual if we've just memorized the rule saying that utilities is always utilities expense debit and we credit cash. So these things, it makes sense right here, but as we record the journal entries, we'll have to really think about it probably and possibly unlearn some rules. Advertising, that's going to be typically fixed. Oftentimes it's going to be fixed advertising. Is it going to be direct or indirect? It's going to be indirect. Now these are going to be things, advertising isn't dealing with production, so it's not within the production. So when we think about direct or indirect, oftentimes we're thinking about the production process. Is this something that we can assign directly to a particular guitar, for example? Or is it something that I don't know which guitar was worked on? If it's selling and admin, it may not, sometimes you might think, well, that's not applicable. That's not as applicable, because we're not really even dealing with production at all. This is going to be, as we see, a period costs. So here you could put like NA, or not as applicable, or indirect. And it's going to be a period cost, meaning it's not part of the production process. It's going to be something we pay for selling and admin. And then we have the manager's salary. So manager's salary, we're going to say is fixed. We're going to say it's going to be because they get paid salary and not wages as we produce guitars. It's going to be indirect. If they're managing the warehouse, then again, we don't even know which guitar they're actually managing. there. So we're gonna have to apply their cost out to the guitars in some format. And we're gonna say it's a product cost because we're gonna say they're managing the warehouse. So this is gonna be a fixed cost as opposed to what we would think the workers of the guitar would probably be variable. We're gonna say this was an hourly, and this is salary. It's indirect even though they're in the warehouse because we don't know which guitar they're working on. We don't know who they're supervising, but we're gonna have to allocate that somehow. And it's gonna be a product cost because they are in the warehouse. So we're gonna have to allocate it out somehow. Admin equipment depreciation. So if we talk about the depreciation for the administrative office, like the fax machines or something like the copy machines or something like that, where depreciation in the administrative office, not the factory. We're going to say it's fixed. It's depreciation. We know exactly what it's going to be. It's going to be indirect or not applicable because it's not in the production. It's not in the warehouse. It's not going to the making of the product. And then it's going to be a period cost because it's in the admin. It's in the administrative office, and therefore it's not part of production. So it's not going to be in the production area. And then we have factory depreciation. Factory depreciation on this type, it's both depreciation here, but notice if it's on the factory, it's still going to be fixed because we know exactly what the depreciation will be. It's a set amount. It's still going to be indirect. Not because it's not in the factory this time, however, it is in the factory, meaning it should go into the production of our guitars, but we don't know which guitar it's going to go to. We made all the guitars in the factory. So if we have a job cost system, how do we apply it to a job? If it's a process cost system, how do we apply it to a process? And so it's going to be a product cost. So it does apply to the product, but it is indirect because I don't know which product exactly it goes to. Something like glue that we use to put the guitar together. It's going to be variable because it changes with the number of units of guitar. We're going to need more glue with more guitars. It's going to be indirect, however, because we don't really know how much glue we used on one particular guitar. So we don't know, we can estimate it, and that's what we'll have to do, but we don't know exactly what that estimate should be. And then it's going to be a product cost. So it's going to be part of the production process. So, and the idea here on glue is it's going to be pretty small compared to something like the wood. So if you compare the glue and the wood up here, then we're going to say, well, the wood is variable, but it's direct because I can assign, I probably had to assign the wood that I took out to a particular job. Whereas the glue down here is variable, but it's not direct, because I probably didn't have to go assign out to get the glue. I just went and got the glue. I didn't have to get any kind of documentation telling me how much glue I'm going to get to put to a particular job. It wouldn't be worth our time to track that. And therefore, it's going to be an indirect cost that we're just going to have to take that glue, whatever we paid for the glue overall, and allocate it using some kind of allocation method. Sales commission. So commission on the sales, it's variable, which is unusual for a period cost. So this is a period cost that would be variable. It's going to be indirect or not applicable because it's not part of the production process. And it's going to be a period cost. So this is one of those costs which are a little bit confusing because most period costs are oftentimes fixed. So most salaries are fixed that are in the corporate office. We don't typically have a lot of variable costs with the sales, except for the commission here. And when we do our different types of allocations, that's going to kind of, how do we deal with that? We're going to have to deal with that when we think of something like projections. We're going to have to break this out to a variable cost, and in that format, it'll probably be grouped more with some of the production costs because we're trying to break out variable versus fixed. Oftentimes when we're looking at projections, that is. So sales commission's variable, it's indirect or not applicable, and it's a period cost because it doesn't deal with the production process. In this presentation, we will take a look at prime costs and conversion costs. When considering prime costs and conversion costs, we are looking at the cost of production. We're looking at production costs as opposed to period costs. When considering production costs, we always think about direct materials, direct labor, and overhead. This should always come to mind when we think about production. Anytime we think about inventory, whether we make it or whether it be made someplace else, its costs include the direct materials, direct labor, overhead. We here talking about a manufacturing company are going to apply these 3 items at this point in time because we are the individuals or the company that is manufacturing the product. So remember, it's not just the materials within the product. That's one component, but the other component is going to be the labor that we're going to put into it. The cost of the labor, the wages we pay are not going to be a period expense, but be part of the cost of inventory to be capitalized, to be put on the balance sheet until we sell the inventory, put on the balance sheet as a piece of the inventory, as an asset. And then the overhead, anything dealing with the factory. Anything that deals with the factory will be part of the inventory. If we have depreciation on the factory, if we have maintenance on the factory, if we've got supervisors within the factory that are paid salary, all that stuff is going to be in the inventory in some way. They're going to be part of the product. So anytime we think of inventory, we have direct materials, direct labor, and overhead. Now, when we consider these in terms of prime costs and conversion costs, there's a bit of an overlap here because the prime costs represent what is going to be directly within the product. Therefore, the prime costs include the direct materials and the direct labor. Now, the direct labor we can't really see within the product, of course, like the direct materials, but it's so closely associated to the product, it's so essential to the production that we're going to call those the prime costs. Now, that's going to differentiate from conversion costs, although there are some overlaps. The conversion costs are the costs that we're going to have that will be used to convert the raw material to the finished goods. The cost that means that we're doing something to the raw material. So in the example of a guitar, the direct material would be something like the wood. The conversion would be anything we do to that in order to make it into a guitar. So conversion costs are then going to include as well direct labor and the overhead, because the direct labor is going to be part of us processing it, and the overhead is going to be included anything that's in the factory, because of course we need that factory in order to convert. So anything like the depreciation on the factory, the supervisor salary on the factory, the small tools that we use, the glue that we're going to use, all that stuff is part of the conversion process, part of the things that we're doing to adding on to that piece of wood in order to convert it from just a piece of wood to the end product, to the guitar. Now, this is going to be an added category that we can start to get confused with something like direct versus an indirect cost. It's a bit different of a concept. We need to keep these separated. So the prime costs and the conversion costs we're often going to use more when we use a process cost system, and we'll talk about a job cost versus a process cost system. But it's different than the direct costs and the indirect costs. Remember that our direct costs are going to be those that are direct materials and direct labor are both direct costs, which happens to be the 2 prime costs as well, but for different reasons. These 2 are going to be direct costs because we can apply those activities to a particular unit. If we have a job cost system, we can apply those 2 activities to a particular guitar. We know which guitars were worked on and can therefore apply these costs to that guitar. Whereas the overhead was indirect because we didn't know which, in a job cost system, we wouldn't know which guitar to apply all the stuff in overhead to. We have to find some way to do that. So if you compare the 2, the prime costs are utilizing the same factors as the direct costs, but for different reasons. The prime cost meaning that they're going to be prime, the prime factors of productions, the primary expenditures, the ones that are going to be most associated with the manufacturing of the inventory. So those 2 are similar. The difference, of course, is the conversion cost does not equate or is not at all the same as the indirect costs. The indirect costs are just going to be the overhead, because we can't apply them. If you think of a job cost system, we can't apply them to the job. That's why they're indirect. That's why they're in overhead. From a conversion standpoint, the conversion means anything that we're doing to the inventory to convert it. So that's why it's going to include the direct labor. So here's where the overlap is. This direct labor becomes a bit confusing because it's both a prime cost and a conversion cost. And when we consider that and compare and contrast it to direct versus indirect, prime costs and direct costs happen to have the same 2 components, but for different reasons. The conversion is not the same as the indirect cost because the conversion represents us converting this information, which will include this direct labor as well as the overhead. In this presentation, we will take a look at some of the differences within the balance sheet for a manufacturer, a company that produces inventory, compared to a company that just purchases and sells inventory, or a service company. And clearly the difference is going to be related to inventory. So the major difference for a manufacturer's balance sheet to a service company, for example, would be that we're going to have inventory on the balance sheet. That inventory will be reported as an asset on the balance sheet, typically a current asset. Now, when we go from a company that just purchases and sells inventory to a company that actually manufactures, produces, makes the inventory, then the inventory could be broken out to components. We're going to have raw materials inventory, we're going to have work in process inventory, we're going to have finished goods inventory. Now, these may be grouped on the balance sheet in different ways within inventory, be broken out into subcategories of raw materials, work in process, or finished goods, or be consolidated in some way. But we're going to have to contend with these components of inventory as we go through the production process. These are going to be balance sheet accounts that we're going to have to track and work through as we track the inventory. You can imagine the physical flow of the inventory going through these inventory cycles. So if we make inventory, for example, we're going to have raw materials. If we make guitars, those raw materials would be things like the wood for the guitar. The wood would then be transferred to the work in process. Work in process is still inventory, but we can't sell it yet because it's in process. So this is the inventory that we're making. The wood has started to be converted to a guitar, but it's not there yet. It still has value. It's still inventory. But of course, these two components of inventory are things that we cannot yet sell. Within work in process, you can also imagine not just the raw materials as we see here, but we're going to include other things in that work in process, which is going to include the direct labor and the overhead. So as you think of these three components of inventory, it's often easy to start to think, well, the raw material went here, and then it changed to work in process, and then we finished it, and it went to finished goods. As we go through that process, we're going to emphasize the fact that it's not just the raw materials that are being here in work in process. It's going to include the direct labor and the overhead within that process. And then that's going to be converted to the finished goods. So once we're done, then we can sell the guitar. It's ready to be sold. We can put it on the market here. It'll be within finished goods that we can then sell. After it's sold, then, of course, it can move to cost of goods sold on the income statement, as we would for a normal type of company, a merchandising company that would just purchase and sell goods. So once it's in the finished goods state, then we're in a similar state as we would be for a merchandiser ready to sell that. The next step, of course, would be that sale. The next step would be us recording the expense in the form of cost of goods sold. In this presentation, we will take a look at some of the components of a manufacturer's income statement, comparing and contrasting where a manufacturer's income statement may differ from a service company or a merchandiser, where a manufacturer, a company that makes the inventory, could differ from a service company that has no inventory, or a merchandiser who just purchases and sells inventory rather than making the inventory. Part of that will be the calculation of the cost of goods sold. So clearly, one of the differences we're going to have from a manufacturer to a service company will be related to inventory. And the major difference between the inventory accounts on the income statement is the cost of the inventory, the expense related to the inventory at the point of sale, that being the cost of goods sold. Therefore, a service company is often going to have just a single step income statement where we group up revenue and then we group up all of the expenses and we subtract out to get the net income. For a merchandiser that has inventory and a manufacturer that makes inventory, we're also going to have the cost of goods sold. The cost of goods sold calculation will be very similar, but it will have some differences that we want to note from a merchandiser company to a manufacturing company. Very important formula. We want to just memorize this formula. We'll be using this formula many different ways. So the merchandiser company, if we thought about the merchandiser company first and then convert and say, okay, what do we need to change to go to a manufacturing company to calculate cost of goods sold? For a merchandiser, a company that just purchases and sells inventory, doesn't make the inventory, the cost of goods sold calculation would be the beginning inventory, what was inventory at the start of the period, the start of the month or the year, and then we're going to add to it purchases. We know what the purchases are because we actually paid for the inventory that we bought, and therefore there's no real estimation in terms of the purchases. That's going to give us the cost of goods available for sale. That's what we could have sold during the time period. If it's a month, we could have sold this many units. How many did we sell? To do that, and this is kind of a periodic calculation, and again, we're going to use the cost of goods calculation whether we use a periodic system or a perpetual system oftentimes, but note when the format of it is kind of more of a periodic type of format, because we're saying this is the cost of goods available for sale, and then we're going to subtract out ending inventory, which we can imagine we got through a physical count. We count the inventory at the end as we would in a periodic inventory system. And therefore, if this is the inventory we had available for sale, the inventory we could have sold, and this is the inventory that we have not yet sold, the difference between those two is what we have sold on a cost basis, and that's going to be the cost of goods sold. That's going to be the expense. That's what will be reported on the income statement as an expense, the most important expense for a merchandiser or a manufacturer, the cost of the inventory that we are selling. Now, if we look at a manufacturer, we can say, okay, how can we convert this in order to deal with a manufacturer rather than a merchandiser? We're going to have that same beginning inventory, and then rather than having purchases, however, we're going to add to it cost of goods manufactured. So we didn't purchase these goods, obviously. We did purchase the materials, but we're going to have cost of goods manufactured, which is going to include what we made in terms of not just materials, but what we made in terms of the work that we put in, the direct labor, and the overhead that's going to be put in there. Now, this number, you might be saying, well, where are we going to get that number? We're going to have to figure that out through our production process. And once we do that, however, this is the number that we're going to use, and it's not going to be purchases. So that's where the big difference is. You can see that they're basically, similar in that purchases is obviously the activity that we had happen through a merchandiser company, and the manufacturer, what had happened is that we not only purchased materials, but we made them into inventory. So that's the cost of goods manufactured. That then will give us the cost of goods available for sale. And then we're going to do the same, subtracting out the ending finished goods inventory. So what has been completed in the finished goods, and that will give us our cost of goods sold. So you can see the two formulas are going to be very similar. Now note that you can use this formula not just for the calculation of cost of goods sold. I mean, if there's a book question, especially multiple choice questions, we'll often maneuver things around so that we'll have to solve for different types of items here. So, and that's one way that a multiple choice question can be used in order to test conceptual components. And so note that any of these components of the formula, a multiple choice question could ask for, meaning the multiple choice question could give us beginning inventory and not be asking for beginning inventory and give us the rest of the data. What we do not want to do is try to memorize a formula to get to beginning inventory, because all we're doing is adjusting the algebra. What we want to do is write down this formula and say that, okay, we have cost of goods sold and we can back into the beginning inventory. The same would be true for if they gave us all this information but not the cost of goods manufactured. We're not going to rewrite another formula to figure out what the cost of goods manufactured is. We're going to use this formula and just use algebra to say, okay, this is the unknown now. I know everything else. This is the unknown. So any question that's going to be related to any of these items, could be ending inventory, of course, as well. You want to just be able to write down this formula and then apply out whatever you need. And also note, of course, that this is a subtotal. This is a subcategory. So sometimes you can actually, if you want to simplify your algebra, then you can eliminate this item, say beginning inventory, plus cost of goods sold minus ending inventory gives us cost of goods available for sale. And then if you do that, then they can ask for, if they give you the other components, they can eliminate any one of these and ask you for that. And what you want to do is just write down this formula, okay, and say, this is the unknown, I don't know that one. So now I'm going to do what I got to do to make that number right. If I know this number, then I can do what I got to do to make that number what it needs to be. If we look at an example here, we're going to say if beginning inventory happened to be 14,000, we're going to add to it cost of goods manufactured, what we made. We're going to say 200,000 here. That gives us what's available, 214,000. Now, of course, note that we're talking about dollars. This is the cost of what we made here. So we're not talking about units. We're going to have to convert that into dollars. And that's a bit, something that more confusing than we might first think to do that. But then we have the cost of available for sale, cost of goods available for sale. And then we're going to subtract out what's still in ending inventory, which we can get from typically a physical count. Now, again, this physical count is in dollars. So we have $12,000 worth. The physical count would be in units, which we would have to then convert in some way to dollars. If this is the number of dollars worth of inventory we had available for sale in the month, and this is how much it has not yet been sold, the difference between the two then is going to be what had been sold, which we're going to say is cost of goods sold. This then is what will be reported on the income statement, reducing sales by the cost of goods sold to get to gross profit and ultimately to the net income. This is going to be our most important expense on the income statement if we are a manufacturer, because it's going to be the highest cost. Typically, the things that we make, if we make stuff, is going to be the highest cost of what we do. And therefore, we're going to break it out separately most of the time and have the sales minus the cost of goods sold giving us that subcategory of gross profit on the income statement. In this presentation, we will take a look at the manufacturing activities flow. We'll take a look at the costs of the manufacturing process and how they flow through the manufacturing process, how we will track and organize these costs as we go. Remember that the major difference between the cost of goods sold calculation for a merchandiser, a company that purchases and sells inventory, and a manufacturer, one that makes the inventory, is going to be that a merchandiser has these purchases item where they're just going to purchase the inventory, and the manufacturer is going to have the cost of goods manufactured. So this number then becomes the number that we need to determine. How are we going to get to this number? If we talk about a merchandiser, it's very easy for us to know what the purchases are because that's what we purchase. That's pretty straightforward. For the manufacturer, however, the cost of the goods we manufacture is going to include more than just what we purchase, more than just raw material. It's going to include the things such as direct labor and overhead. So we'll take a look at this in three broad categories where we'll have the materials, we'll have the production, and then we'll eventually be selling the materials we're making. Remember that the end process here is, of course, the production of inventory, the ultimate goal to be selling it. So most of this that we're thinking about is all kind of balance sheet stuff until we get to the end when we sell it, which is going to be similar to a merchandising company where once we're at the end, we sell it, moving it from the balance sheet to the income statement in the form of cost of goods sold. So first we have the materials that we think of, and the materials we can think of will run through a similar process as when we just buy and sell inventory from a merchandising company, meaning we're going to have the materials that's already in the warehouse. The materials that we have from last month are still there this month. We're going to include to those materials what we purchase, so we're going to add purchases to those materials, and then we're going to subtract from them ending materials. What is still there. We're going to count the materials. Those will be the ending materials, and that will give us the materials used. Now, this calculation should look pretty similar to our cost of goods sold. You want to be able to understand this calculation because it's the same kind of thing for cost of goods sold for a merchandising company and similar to the cost of goods sold for a manufacturer as well. Note we have the beginning inventory, materials. We could have a subcategory if we wanted to, say materials available for use, and then we're going to subtract out the ending materials to give us the materials used. So this is going to be our purchasing, and you can think of this just as us purchasing the materials that we have and going through this process to determine the materials that we're going to use within production. Now, once that happens, we're going to say, okay, that's going to go to our production area here. This number here is going to be part of production. This is what we used to produce. But it's not the only thing that we had in production, because in production, we also had the beginning work in process. When we think about production, we're thinking about what's in process. Work in process, WIP, WIP is often used here. So we're going to say, well, we already had some stuff that was in work in process. Now, in this month, according to this calculation, we included more materials here based on this calculation to the work in process. And so we're going to add that in. But we're also going to add direct labor and the overhead. And these are the two areas that are often overlooked within the production process, because when we think of goods and services, we often think of just the stuff it's made out of. It's made out of plastic. The guitar is made out of wood. But of course, the major components that comprise the cost of it are labor and overhead. So we have to include that in the production process. And these two items are the confusing things to most people, because they're going to differ when we record them here as to when we had a service company or a company that just buys and sells inventory. Because some things like utilities on the warehouse, some things like depreciation, we're not going to expense them as we had in the past. We're going to include them in the cost of production. We're going to include them in the cost of inventory. And then we're going to subtract out the ending work in process, what's still there, what's not completed yet. So we're going to count what's still in the ending work in process and not yet done. And that'll give us the cost of goods manufactured. So again, these two calculations, you can see of them as similar. They're similar in nature, meaning we had beginning work in process, and then not purchases, but the materials used and all the labor. These three items being what we added to it, what we made from it. We didn't buy it, we made it. We transferred over this, and then we added the labor and the overhead. Those are all costs that we put into it. We could have then we could then have a subcategory if we chose to, which would be work in process available, and then subtract out the ending work in process. So it's similar formulas that we have here. This time our bottom line number getting to cost of goods manufactured, not to be confused with cost of goods sold. Cost of goods manufactured is what we made during this time period. Cost of goods sold is going to be what we actually sold during this time period. Cost of goods manufactured will be used in the calculation for cost of goods sold, however, which would be the beginning inventory. Beginning the finished goods inventory. So now we're looking at the goods that are done now, the finished goods inventory, and then we're going to add to it the cost of goods manufactured. Instead of, as we would for a merchandiser, a company that just purchases and sells inventory, where this would be purchases. So this is the differing number here between those two. That's going to give us the goods available for sale, just a subcategory. This is what we could have sold during the time period. This is our calculation of cost of goods sold that we saw prior. And then that's going to give us our ending finished good. And then we're going to subtract from that our ending finished goods inventory, which we could get from a physical count, to finally get the cost of goods sold. Now notice we have the sales item here. The only area here that's going to be on the income statement is the cost of goods sold. And it's not the sales item. We don't know what we sold it for, or we would, but this flow doesn't track the sales price. The sales price has nothing to do directly with the cost of the goods sold. We might use the cost to derive the sales price, but this, remember, we're tracking the cost. So when we sell something, if it's a perpetual system, we're gonna debit cash or debit accounts receivable, credit sales revenue. Sales will be recorded. That's the part that's not here. We're also going to debit cost of goods sold, the expense, and reduce inventory, and that's in credit inventory. And that's what we are tracking here. This is going to be the cost of goods sold, the expense portion of the sales we make. When we make a sale, we have the related expense of cost of goods sold. Note that this expense, this one time that we're finally hitting the income statement, is comprised of all this activity that we've done. The direct materials are included in it. The direct labor is included in it. The overhead is included in it. All that stuff that we've been tracking this whole time and haven't been putting on the income statement at all we've just been putting it on the balance sheet as just lumping it in together as part of inventory, is finally being expensed all together as we sell it in the form of cost of goods sold. In this presentation, we will take a look at the manufacturing concept of a just-in-time inventory system. The concept of a just-in-time inventory system is going to be that we're going to start to put together the inventory after we get the order. In other words, we're going to get an order from the customer and then start to put together the inventory. For example, if we're a Dell computer and we're putting together computers, we're going to get the order for the computer before we start to assemble it. There are pros and cons to a just-in-time system. One of the pros is it's often considered to be more customer-focused because we can allow for the customer to give us a bit more customization if we're going to create and put together the computer after it has been ordered. It's also helpful that we may not have to have as much cost in just inventory being stored if we're able to just create these computers as we go. We don't need as much warehouse space. We don't need to just be storing computers. We don't need to deal with the risk of those computers that already have been assembled to go down in value and no longer be desirable in the market. We can just build them as we go. So the concept is we're going to get the customer order and then we're going to schedule production at that point in time. Notice this has to happen pretty quickly. Because we want to get the computer out pretty quickly. So all these components of production then are going to have to happen smoothly. And that's going to be one of the downfalls, of course. If there's any problems with any of these processes along the way to the production of the computer, then we don't have any warehouse in order to just go and pick up a computer. So that's going to be one of the risks that we have. Then we're going to get the materials just in time for production. We're going to go ahead and get the materials. That means we have to have a good relationship with our suppliers and make sure that we can get everything we need at the point in time of order. And as long as these things are all secure, then the just-in-time system the benefits will outweigh the cost. And then we want to complete the just-in-time for assembly. So we're going to complete the parts so that we can assemble it. And then we're going to complete products just in time to ship. So notice all these things are basically happening very quickly after the customer has made an order. And all these links along the way for it to work well need to have good communication with our suppliers. We need to be able to assemble everything in a systematic process and have everything done fairly quickly. If that's the case, then we have the benefit of being able to have a more customer-centered design so that we can have some more flexibility in the types of products we're going to put together. And that's generally going to be beneficial in what customers are looking for oftentimes these days. In this presentation, we will compare a job cost and process cost system. When we produce inventory, when we are a manufacturing company, we typically will be using either a job cost system or a process cost system. And the difference between these two, which one will we use, will typically depend on the type of inventory that we produce. So let's go through the characteristics that will generally be apparent or be present when we use a job cost system. And when we look at these, we want to compare and contrast the two. When would we use a job cost system? When would we use a process cost system? As we start to work through problems of a job cost system and process cost system, we'll start to see why these characteristics of inventory are going to be those that will distinguish whether we choose to be a job cost system or a process cost system. For now, just note that a job cost system means that we're going to apply the cost of the inventory to particular jobs. So we're going to have a particular job, we're going to assign the costs to that job, as opposed to a process cost system where we're going to assign costs to a process as we go. So as we think of this, we're going to think of the example of custom guitars. Pretty much anything custom that you can think of, that's one type of thing that would basically usually be in a job cost system. So if we get an order for a guitar, it's going to be a specific type of guitar, and we're going to custom make this guitar in accordance with the order. We would typically use more of a job cost system. It's also something that if you think of custom for like construction and stuff like that, construction jobs are typically going to be different in nature, and therefore we typically use a job cost system. So that's the first characteristic we'll have. If it's a custom order, then we're typically going to use a job cost system. Now, I would use that characteristic in order to then think about the other characteristics as following from it. Meaning, if we do some type of manufacturing business that's custom in some way, then the other things are going to follow from it. If we make custom guitars, if we do any kind of construction, it's going to be custom to whatever needs to be done. Then we're typically going to be doing a job cost system. Our next characteristic are heterogeneous products or services. And that just means that they're different. And the reason I use this word is because sometimes you'll see it in textbooks. So heterogeneous and homogeneous. Heterogeneous being the opposite, meaning different, and homogeneous meaning the same. So this, of course, follows that we can just say, of course, that the types of things we're producing are not all exactly the same. And that follows from the idea that they're custom. They're different in some way. We've got some differences in the production that we have. And because of those differences, we cannot do things like just allocate the costs evenly to whatever we're making. If one guitar we make is a lot more detailed than another guitar we make, then we cannot evenly allocate the costs. And that's going to be one of the reasons we use a job cost system. If we do a construction job and one happens to be a lot larger than another, then we can't allocate the same cost to those two jobs, or we shouldn't. We should find some other way, and that's why we're going to use a job cost system as opposed to a process cost system. Low production volume. Now, low production volume means that we're not producing as many of the items possibly as in a job cost type of inventory system, meaning if we're making custom guitars, then we're going to produce far less of them. That's okay because we're going to charge a higher price for the ones that we produce, as opposed to if we were just stamping out the guitars and they were all the same, then the idea there is that we're going to have a high volume, less customization. So a job cost system follows from the idea that we're going to have some differentiation, some customness, and that means that the products are going to be different in nature. Differences in nature of whatever we make typically would mean that the production volume will be lower. And then we're going to have high product flexibility. Again, that's going to follow from the idea that they're custom. So if something's going to be different in nature, if anything that we're making that's going to be different, and we might just specialize in, even if we're just specializing in guitars, and even if it's fairly limited, if we have the more customization we have within that guitar, the more we're going to need to have a job cost system as opposed to a process cost. If we're in construction, of course, we might do the same type of construction all the time, but the jobs that we go to and deal with are typically going to be different just by the nature of the job. And so we're going to have to have differences there. There'll be flexibility that we will have basically based on the fact that they're going to be custom in some manner. Also, the job cost system will typically have higher value, higher dollar values for the products as opposed to a process cost system, because and that leads through the customization. If we're going to customize it, then it's going to take more time and it's going to cost more, as opposed to if it was all just being the same thing. Our goal there is to lower costs and have it be typically cheaper. So if we contrast this to a process cost system, the idea of a process cost system is we're going to apply the costs to the process. And the reason we can do that is because all the things that we make are going to be, in essence, the same. So that's going to be our root, again, that we want to think about, as opposed to something being customized. Here, everything, it is what it is. You get what you get. It's all going to be the same. So we don't need to apply the costs in the same way. We need to apply the costs all evenly to the units. So what we need to do then, we can do that by using a process cost system, assigning costs as they go through the process rather than to particular units of inventory, particular jobs. So in this, I would think of something like taffy. If we're making taffy or caramel candies or something like that, they're all the same. We're not going to vary the caramel candies. They're all the same. So we're producing our inventory. So other things like oil is going to be like that. For processing oil, it's all the same at the end of the process. So our goal here is to make everything the same and lower costs. So we're going to have then repetitive procedures. Everything is going to be the same. And our goal here again is just to make everything the same, even mechanized if possible. Have the whole machine make the taffy and go through just the process of making the taffy. And once we automate the system, because they're all the same, then that should be lowering the cost. We're going to have homogeneous products or services. as opposed to heterogeneous. So they're all the same. And again, this is probably the one that here you want to focus in on, or the fact that they're not custom. So we don't have custom products. They're all going to be the same in nature, and therefore everything else pretty much derives from that. We're going to have high production value. That's the point of us making everything the same. We're going to say, yeah, there is no variance. You want caramels with different kind of things in them or whatnot? We don't do that. We just make the caramels. They're all the same, and we have a pretty low cost because of that. The more we try to customize the caramels, then the more it's going to be difficult for us to automate the process. Then we're going to have more customization. So if we keep them all the same, we can have high production volume and lower cost. Low production flexibility, again, that follows from them all being pretty much the same and not being customized. So we're not going to vary what we produce. We're going to say that these are all we're all going to produce the same thing for every unit is going to be the same. So if we look at these together, then the job cost and the process cost system, remember that the job cost system has the custom order as opposed to non-custom orders or just repetitive procedures on the process cost system. So this side's going to be custom. This side is not custom, and that means that we're going to have everything be repeated. It is going to be what it is. And then we're going to have heterogeneous production for the job cost versus the process cost, homogeneous. And again, this kind of falls out from the fact that these are custom and these are non-custom. So these are going to be all different products and services through that customization. These will all be the same. The job cost system, low production volume, again, because they're all different in nature, and a high production volume for the process cost system. Because they're all the same, we can then scale up and be able to produce a lot more. Then the job cost system, high product flexibility, we can vary. That's the point. That's the point of having them be custom. On the process cost system, we have low product flexibility. And again, that's the point, because that's what leads us to be able to produce more at that time. In this presentation, we will take a look at a job cost system, cost flow. We'll look at this cost flow a few different times, a few different ways, but now we want to get an overview of that cost flow so we get an idea of where we're going. We'll then look at the cost flow as we go through a comprehensive problem. When we go through a comprehensive problem, however, we often start to look at the very specific component that we are on in a fairly long problem. So as we do that, we want to get an idea and keep an idea in our heads of what the overall cost flow will be, so that we know when we're focusing in on one particular component, how it fits into the big picture. That'll give us some more context, more motivation to learn the particular step that we are looking at. So whenever we think of manufacturing costs, we want to think of materials, overhead costs, and labor. And just about any inventory that we think of, not just in terms of if we are the manufacturer, they include these items in it. It's easy to think of inventory as materials. So if we think of a TV, we think of the materials that are in the TV. But notice that a lot of that is going to be due to overhead and labor. A lot of the cost, a lot of the value, a lot of what it is. If we just took the raw materials of a TV, that wouldn't amount to much unless they were put together to format a TV. So it's important to note when we do a manufacturing company, of course, we are providing some of those products, some of that value. So we have the raw materials, we're going to have the overhead, we're going to have the labor. We're going to have to account for all three of those in the cost of whatever we make. If we make a TV, we got to include all of those in the cost of the TV. We have to track all of those costs so that we can include them in the cost of our inventory. How will that work then? Well, if we start with our materials here, clearly we will buy the materials, whatever's going to be used to create our TV, the plastic and whatnot that are going to be used to create the TV. We're going to have those, and that's going to be a part of inventory. And then we're going to start to work on those. And once we do that, we're going to put it into what we call work in process. So work in process is us starting to convert whatever the raw materials are to the finished product, the TV. So now our materials over here are going to be taken from the materials and put into a work in process as we start the job, as we start to get going with the process of making. Now we want to keep in mind that this work in process, this is going to be an account called work in process. And when we're thinking about a job cost system, we're not going to be able to apply anything to this work in process unless we can assign it to a job. So if it's within work in process, we need to have it be supported by a job. And that's going to be similar to if we had, say, an accounts receivable account. We can't apply anything to an accounts receivable account unless we also have a subsidiary ledger and a customer to apply it to. We need to know who owes us the money. Well, when we go to a job cost system for work in process, it's similar. If I put this materials from the materials to the work in process account, I need to know which job that we're working on. And so that's going to be our criteria. Now, if it's direct labor, if we're making, say, let's go back to the guitars. If we're making a guitar and we're putting the wood in the guitar, we know exactly which guitar the wood's going to. On the other hand, if we're talking about some of these materials that we don't know exactly which guitar it's going to, things like glue, things like small components that are going to be included in the guitar, it's not worth us to track exactly which guitar they go to. We're not going to get a requisition form and say, I need this specific amount of glue to put together this guitar. It would be not cost effective to do so. So what we'll do is we'll take some of this material and we'll put it into overhead. We can't put it up here yet. We can't put it into the work in process account because we can't assign it to a particular job, and nothing goes over here until we can assign it to a particular job. This overhead is also going to include any other type of overhead that we have. So when we think of overhead in general, these are all types of things that we basically expenses on the warehouse where we make things. So that's going to include things like depreciation on the warehouse. If we have a supervisor salary in the warehouse, we don't know which job that they're working on, so it's going to go into overhead. If we have maintenance in the warehouse, then all of that's going to go to some inventory, but we don't know which job to assign it to, so it's going to be in there. If we have utilities in the warehouse, it's going to be in overhead. And that overhead then, of course, is going to be a cost that will be included in overhead. Then we're going to take that overhead and we will assign it to the work in process. How will we do that? That's going to be one of the things that we'll have to figure out, because we cannot just take this overhead and assign it to work in process. We can journalize it in there and put it into that account, but we need to know which job it goes to. And that's going to be one of our problems, one of the things that we'll have to figure out. From this step here to assigning the overhead to a job, we're going to have to figure out which job gets how much overhead, because some of the guitars are custom guitars, some of them are more specialized than others. It would be similar if we had like a construction company. Some of them are larger companies, some of them are smaller projects and larger projects. We need to know how much of the supervisor salary or how much of the small materials we use, how much of the truck and gas possibly would go into each individual job when they're not all the same in size, and we don't have any way to assign them particularly to each job. So that's going to be one of our problems that we'll talk through as we work through the job cost system. The labor, same thing. We're going to take the labor and we're going to assign it to the work in process. And that's going to be direct labor. So anytime we have someone working on a particular guitar, it's pretty easy for us to see which job, which guitar that person is working on, and therefore be able to assign their cost directly to work in process and back it up by job cost sheets. However, we may have some people working in the warehouse that we cannot assign to a particular job. And those would be things like possibly the supervisor salary, possibly the maintenance in there, because we don't know which job it goes to, and therefore we're going to say, well, it's still labor. It's going to be labor. We're going to have payroll happening, but some of that labor is going to be directly to the job, direct labor, and some of it will be indirect. If we can't assign it directly to the job, then we're going to include it as well in this overhead. So you can see this overhead is a big bucket of stuff that basically we cannot assign, or it would be not cost effective to assign directly to a particular job, and therefore we will use some other format. Once we have these items in work in process, at some point in time, we are going to finish them within the work in process, and we can then transfer them to the finished goods. So once we're in finished goods, then the finished goods is going to include all of these items, raw materials, overhead, and labor. within the job, but we're basically going to have a job that will be completed. And that job will be in finished goods. We'll have the concept or the account of finished goods. Note that these two accounts on the general ledger are just going to be one account on the general ledger. We're going to have work in process, but within work in process, it's made up of job cost sheets. So these are like sub ledgers that are backing it up in a similar way as accounts receivable would be one account on the general ledger, but it's supported by a subsidiary ledger breaking that information up by customer. So in this case, all of these accounts, remember, are going to be broken up or backed up, supported by a general ledger account, breaking the information out by date. But these are also going to be supported by another account, another ledger, another source document that's going to give us the information in terms of jobs. So the finished goods then is going to be one number. We're going to transfer it from work in process to finished goods, but we will still know which jobs are going to be applied to the finished goods. And those jobs, of course, are made up of materials, overhead, and labor. And then once we have the finished goods, we're kind of at the end product now. Now we can sell them. If we're talking about guitars, we can sell them now, right? So now it's the final step, which is similar to a merchandising company. We sell, and that'll go to cost of goods sold. Now, as we go through this process, it's easy for us to forget about just the normal sales journal entry, because this whole process leads up, of course, to us selling the inventory. That's the point of the business. But none of this is tracking the sales price. We may use the cost sheets to derive the sales price, but the sales price is not directly related to what we're tracking here. We're tracking the cost. So at the end of the day, the last journal entry is going to be increasing sales, credit to sales, and debit the accounts receivable or cash. And none of that journal entry is not being represented here because we don't know exactly what the sales price is based on this information. What will be here is when we make a sale in a perpetual system, the second half of that journal entry is debit to cost of goods sold, the expense related to the sale. That's what's here. And a credit to inventory, a reduction of the asset related to the sale. And of course, that cost of goods sold then is going to be comprised of jobs that we're selling, a particular job that we made, particular guitars or particular construction jobs. Those jobs consisting of materials, overhead, and labor. In this presentation, we will take a look at a job cost sheet. A job cost sheet is going to be used to help us to track the costs of inventory or jobs to a particular job. A job cost sheet or job cost system could be used for a manufacturing company that produces inventory. It could also be used for a service company that's tracking, say, time that goes to a particular job, say a legal firm or an accounting firm that needs to track the time that they put in to a particular job would use a similar system in order to track those costs by job. In a construction company, oftentimes we're going to use a similar job cost system because, again, those jobs are all going to be different in nature. We'll have to track the costs to jobs. If we make something like anything that's going to be customized guitars or something like that, if we produce inventory, in other words, we're going to have the same kind of issue that we're going to need to be able to track the costs to the particular job. The inventory is usually the one that we work with in a manufacturing company that makes inventory because it needs to track the costs to job and has the added complication of dealing with inventory, meaning materials that we'll have to be dealing with. Now, the job cost sheets are going to be a type of subsidiary ledger. If we think about all the job cost sheets put together, they are going to support amounts that are going to be on the balance sheet. In other words, when we have work in process, when we start the work in process, the inventory account that's going to be tracking what we're doing in terms of the inventory for putting together guitars, and we're tracking the cost, the direct materials, the direct labor, and the overhead of those guitars on the trial balance on the financial statements as an asset in inventory, then that number needs to be supported by something like a job cost sheets, multiple sheets that will be reporting and supporting that in a similar way as every account has a GL account. Every account has a GL account, and that gives support to those accounts by date of transaction. Some accounts need more than that, however. For example, accounts receivable, it's not enough to have a GL account. we also need to know the supporting subsidiary ledger by customer, which customers owe us money, so we can track that and hopefully collect. When we talk about the inventory account, we're going to break that out to work in process and finished goods. Whenever something goes into work in process, it's not enough for us to just know the date of the transaction, as will be on the GL, the general ledger. We also need to know which job to track these costs to. So this is similar to tracking the accounts receivable by customer. Here we're tracking the work in process by job that we have, the job that we're applying this to. Now, the job cost sheet could have a customer here. It may be the fact that we're assigning jobs, we're making jobs, and maybe we don't have a customer. We might be in a system where the customer custom orders the job, and therefore we have the customer that we're going to start to create the job for. And that's typically the case, because if we're in a construction company, if we make custom anything, we're typically going to get the order, we're going to know the customer, and then can create the job, typically with a job number from it. But it's possible for us to make a job for something that we're going to have that on display or something like that, and not have the customer at this point in time, right? But we would have, of course, a job number. We need a job that we're going to be working on. So it would be depending on the industry in terms of how these job cost sheets might be formatted. We could have the address, the job description, depending on what we're making. If we're making custom guitars, we might say the type of guitar that we're making in general. We might have the date of the proposed date, the date started, and the date completed on the job. And of course, when it's completed, that's when this job then would go from work in process to finished goods. It would then be done, and we can make the general ledger transfer from what's in process to the finished goods. Now, any job cost sheet, no matter what we're dealing with, is going to have the three components, unless it's a service company, right? If it's a service company, if we're a law firm, or if we're a bookkeeping firm, all we really need to track is the labor, the hours, the labor that we had. So if we work on bookkeeping, we need to know how much time we spent and who spent the time and what their billable rate is for any particular job. So we would have this, and then we're going to have the overhead of like the office space and whatnot that we may include in a job cost sheet. So those would be for a service company. Of course, it's a little bit more complex for a manufacturing company, because they're going to be dealing with materials. So if we deal with a manufacturing company, like making something like custom guitars, then anytime you think of inventory, anything that deals with tracking inventory, what's the value of inventory, its value is the direct materials, the direct labor, and the overhead, all the other stuff. So those are going to be the three components of our job cost sheet: direct materials, direct labor, and overhead. And then we're going to have to track that information in some way. So the direct materials we may track by the date that we brought the materials in. If we have a long job that we're working on, we may have multiple dates that we're going to have here. Something like a construction company might have, of course, multiple dates of materials. Requisitions, meaning we might have, that's going to be the document that we're going to use in order to requisition materials. If we're in a large company, then we're going to have to get the materials from, purchasing or the materials department. We're going to have to ask for those to happen. We're going to have to requisition those. We might list out the requisition number if that's the case. But at the minimum, we probably want the date and the cost of the materials per job. And then we're going to have the direct labor that we're going to have. And again, if it's a construction company, we might have multiple dates and multiple people at multiple different rates that are working on a particular job. We're going to want the date, and then we're going to want the time ticket or some kind of tracking to a source document to be able to know how much time and what the billable rate that we're using is for these. So we're going to source these out again, and these time tickets are going to help us to know exactly how much to apply to these particular jobs. And again, this could get kind of complicated because we might have multiple people at multiple different billable rates. And of course, a computer system can help us out with this. But at the minimum, we need the date and we need the cost that we're going to have for the hours that will be worked. And the hours worked, we might be charging just per hour on our direct labor. It's basically the payroll that we have here. We're processing the payroll and allocating the payroll not to an expense as we process it, but to whatever job we're applying to. And then we've got the overhead, which is always the most confusing part, both to us creating it and when we try to explain something like this to a customer, how much it costs us. And the overhead, we're going to say we're going to have a predetermined overhead rate. And here we're going to say it's 160% of direct labor. It should be labor cost. And notice that that it has nothing to do with labor in particular, but labor can be used as a way for us to know how big one job is compared to another. So, for example, if total labor was 1,000 for this job and it's 2,000 for the second job, that might be a good way for us to say, well, that means that we should be applying, twice as much of overhead to the second job, not because there was more labor, but because the more labor indicates that it's a bigger job. So we're using direct labor as an indicator to allocate the overhead. We'll talk more about that allocation and how that works, how we get to this number here, but just note that the overhead's going to have to do with everything else that's involved. So if we make the guitar, everything in the factory. So the depreciation on the factory, any small materials that we use in the factory, the indirect labor in the factory, the indirect material in the factory, anything, utilities in the factory, anything in the factory. And then if we sum these up, then we got the materials, we've got the labor, and we've got the overhead. That's going to be our total cost. Now, if you look at this, you might say, this looks a lot like an invoice or like a bid that we might make on, say, like a construction company or something like that. And it is very similar. But note that this is tracking basically the actual costs here. So this isn't a bid, which would look the same, but it would be before we do any work. This is basically the actual cost as close as we can. Of course, this is an estimate over here on the overhead, but this is the actual cost. And note that a bid or an invoice won't stop here because this is only the cost. We might include this in our invoice. We might tell our customers, hey, here's our invoice. The materials cost this, the labor cost this, the overhead cost this. This is our best calculation of what the cost is. And our markup is whatever it is, right? If we have a 30% markup, we might say that then how much are we charging you? 3266 times a 30% mark of 1.3, and then get the amount that we're going to bill. So this might be the start to the bill, in other words. But then we're going to say that based on that, we're going to give our markup, and this is the actual amount that we might have, say, if we were using this to create a bill. So note that, of course, if we had a process in a construction company, if it was a big job, we would probably set a price at the beginning based on an estimate that would be similar to this, but it would all be estimates. And then we might tell our customer that we're either going to, abide by the estimate, or we are going to make adjustments if the costs run over the estimate. And then once we have the end product here, here's the end product, here's our end cost, we might use this then for the invoice, basically, and mark it up. So this looks similar to the invoice, but it might be used for invoicing, a similar type of process, but this is going to be the actually used for the allocation of the job. What we will definitely use this for is when we sell this, if this was a guitar or something, if this was a job, once the job is done, once we sell the inventory at the end, then we will debit accounts receivable or cash, we'll credit sales, not for this number, possibly for that other number that we just looked at. But then this number will be used to debit cost of goods sold, the expense on the income statement, the cost of the inventory we used, and then we'll credit the inventory, lowering the finished goods inventory by this amount. Also note that this is only one job here. So when we think of the work in process account, what's reported on the balance sheet in work in process, it's going to be the sum of all these jobs. So this would be like one customer. This amount would be like similar to one customer on the accounts receivable subsidiary ledger, and we'd have to add up all the customers to get to the number on the balance sheet. This is like one job on our job sheets, and we would have to add up all the jobs that are open that haven't been finished yet in order to add up to what is being included on the balance sheet in work in process. In this presentation, we will take a look at a materials ledger card and materials requisition form. This is going to be an example of a materials ledger card, And you can note that it's going to look very similar to us tracking inventory. We're basically tracking the inventory of materials. So if you work with a merchandising company, a company that purchases and sells inventory, we'll have a similar kind of tracking system that we might use for the tracking of inventory. In this case, of course, we're using it for one component of inventory, one component of in this case, the type of services or the type of inventory that we make. So if we make guitars, for example, the major component might be wood. And so we would have to track that major component in a similar way that we would have to track the entire units of inventory for a merchandising company. So we might have things like on the inventory items, in this case, we're going to say it's the wood planks. We might have a stock number. We might have a location in the storeroom if we have a large storeroom, maximum quantity, minimum quantity, and quantity to reorder, a reorder point when we want to reorder. And then we're going to break this out then to the received, issued, and balance. So this means received, like we purchased it and we have received it. So this is when we're getting the inventory. Issued would be similar to our sales type of item or their cost of goods sold if we were a merchandising company. In this case, we're not selling it. It's not leaving the company. It's going to another department. It's going from our warehouse basically to the production department, to the factory, to the work in process. And then we're going to have the balance here, which is going to be what is kind of on the balance sheet as of the ending product. So if we think of the balance sheet, this is going to be what is still included in our inventory items of just raw material. And then we might be tracking this information. For example, on March 4th, we said we had received. So we have a receiving report, and this is going to be the documentation we might use in a large company to tie this out to the receiving report. So in other words, this came from a receiving report. The warehouse would have received this information, counted it. We have then the receiving report, 2 units, and then we're going to have the unit price, 225, and then the total price is the 2 units times the 225, or 450. Now, if we bring this over to the balance, we started with 1 unit at 225 or 225, and now we're bringing over this 2 units. So now we've got the 2 units and the 1 unit, or of course 3 units. They still all cost 225, and therefore 3 times the 225 means we have a total of 675. So as of March 4th, we have $675 worth of inventory for wood planks. And then we're saying this time we have an issuance. On March 7th, we had an issuance. Why would we issue? Well, there was a request from the work in process for, say, there's a new guitar we need to make, and they ordered some planks of wood, 1 plank of wood apparently. And we then have a requisition form. That's going to be the form from the work in process, the factory, saying, hey, we've got a project that we need to work on. Here's the form. We're going to say that's for 1 unit, 1 plank. Cost $225. Notice this isn't the sales price. We're not dealing with any sales. This is all internal. We're purchasing, going from one department to another, now to work in process to the factory. Here's the total. If we go to the balance, then we had 3 units. We just issued 1 from the warehouse. So how many are left in the warehouse? Only 2 times the 225, and that gives us the 450. Now, a couple things to note here. Note that obviously you might think, well, wait, we still have 3 units because it only went from one department to the other. And that's true, but we're not going to be tracking it here in work in process now. It's not going to be included in the balance sheet account of materials. It's going to be included in the balance sheet account of work in process. We're going to apply it, this 1 unit. Now it's going to be applied from this materials to the work in process GL account and be supported by a job cost sheet as opposed to being tracked in our just materials ledger. Also note that this system works well if these units, planks of wood don't change in value, meaning if the planks of wood become more expensive over time just because of inflation, then we're going to have similar issues that we have with inventory tracking. We're going to have to use some type of method, actual cost of the inventory, and track it, specific identification, or probably some kind of cost flow like first in, first out, the assumption that we have the first in, first out assumption, last in, first out, or average. So we'll have those same kind of inventory tracking problems that we have for the materials ledger as we would for just inventory in general. And then this would be the requisition form. So when we had this item here, this isn't going to be the same form, but when we had this requisition, this is the type of form that we would use for the requisition. And remember, in a big company, then we would have to have this process of one department requisitioning. So if I'm in the warehouse and I'm asking for a plank of wood, I'd have to go. I mean, if I'm in the work in process, the factory, and I need a plank of wood to make our project, then we might have to use a requisition form to get that wood from the warehouse. Now, of course, the smaller a company is, then, and if we're a construction company working on a job, then the requisition forms might be similar to just the receipts, that we're using in order to purchase materials that will then be supportive of what we're going to be using in the work in process. So the requisition form here is being used for us to take it from the warehouse that it's already been purchased. But it's also going to be the form that we're going to use in order to apply it to a job when we create the job cost sheet. So the requisite, and so when we create, if we were a smaller company, we might use receipts to create, of course, the job cost sheet for the materials that we would be purchasing. So we're going to have the job number that we're going to have on here, the materials, the quantity that we need, 1 plank of wood, quantity provided. Hopefully they're the same, unless the department didn't give us, maybe they didn't have. The warehouse didn't have all we need. And then we usually have it filled out by, because we want to be able to track an audit trail that we have here. And we've got the date, the materials description, the plank of wood. This is the requester, and this is filled by. So obviously we want to have the 2 individuals. We want to have someone requesting, one filling it out. That gives us a system of controls, meaning it would be difficult to steal the plank of wood if we have to have 2 people involved in the requisition process without having some type of collusion in order for that to happen. Date provided and material received date, and any remarks that we might have. So this would just be the form, just a form for us to get that wood from the warehouse to the work in process so we can start working on it. And remember that all ties out to this form as well. So this requisition form is going to be used here on the material side to get the materials out of there. And it's also going to be used on the supporting document. Not that this isn't the actual form we'll see here, but it'll also be used in this document, which is the job cost. So we're moving the materials then over here to the job cost system. So we still have our job 15, and we're going to allocate this requisition form to it. And that will mean that we're still tracking the wood. It's still there. It hasn't left the company because we haven't sold it yet. But now we're tracking it in the account of work in process, and that account is not supported by us tracking the inventory in just planks of wood. It's supported by our job cost sheets. So our job cost sheets are now supporting that piece of inventory, and we're going to have it in this job cost sheet up until it's finished, and then the job will move to finished goods, and it'll still be supported by this job cost sheet, and then we'll finally sell it. And once we sell it, we'll then move all these costs, all these inventory that we bought, and all the material we bought, all the labor we did, all the overhead, will then be finally expensed in the form of cost of goods sold at the point of sale. Now we'll take a look at a journal entry related to the materials requisition. So every time we have a materials requisition, we're going to have a journal entry for it for the general ledger accounts. Here we're going to say for all these different jobs. So we're looking at all these jobs and we had all these requisitions for these jobs. We're going to sum up those requisitions. So we're just taking these documents and summing up the materials that were requested. And that's going to come up to a total of 2,230. So the journal entry then we will have is going to be the raw materials going down. The raw materials here are going down. And then it's going to be moved to the work in process account. So raw materials is an asset account. It has a debit balance. We're moving it from the raw materials from the warehouse. So that's going to decrease, and we're going to move it not too far to another inventory account to work in process. So work in process is an inventory account. It's an asset account. It represents the inventory we're working on. It's going to be increased. Now that's going to be for the direct materials, those that we can apply directly out to the guitars if we're making guitars. Now there also might be some materials that are indirect, meaning something like glue or something like that if we're making guitars. And if we say that there was requests for glue or something like that that was indirect, that we couldn't assign to a job, no job applied it, we just are basically taking stuff from the warehouse and assigning it just in general to be in the warehouse. We just gave them glue that can be assigned to anybody who wants to use it in the middle on any guitar that they start to work on. Then we don't know which job to apply it to here. And so those may still come out of just the materials. We might still have just materials that will be there, or we might try to track those types of materials separately. So in other words, we might have a materials account that includes all materials, direct and indirect, or we might try to have another account just has the indirect stuff and track those separately. In this case, we're going to say they're all in raw materials. And then the indirect materials, we're going to say, okay, that raw materials is going down by 550, and the debit's not going to work in process. Why? Because we don't know which job to assign it to. It just went into the warehouse, and anybody who's making a guitar, either any of these jobs that are working on a guitar, can use the material. So that means that we can't assign it yet. We can't put it to work in process because we cannot support it. We can't back it up by particular jobs. So therefore, we're going to put it into the bucket factory overhead. It's still kind of an asset because ultimately it's going to go into the work in process. It's just that we're going to have to assign it to a job first. We're just going to put all the stuff into a bucket and then find some way to assign it to a job. So if we look at those journal entries, then we're going to post out the work in process, started at 0. It's going to go up by 2,200 to 2,200. And you can see that work in process then is here on the trial balance. And then the raw materials, here's the general ledger for raw materials. It was at 1,500, 150,000. It's going down with a credit, 2,230 to 147,770. So we just moved it from raw materials to work in process. And then this side, factory overhead, went from 0 up by 550. So here's the factory overhead at 550. And then the raw materials are going to go down again. So raw materials, 147,770, going down by 550 to 147,220. And that then is going to be the 147,220. So yeah, it was 147,770 before. Now it's down to the 147,220 that's represented here on the trial balance after both of these have been completed. Note that none of this whole process, is not doing anything to the income statement. We bought the materials, we're starting to use the materials, never going to hit the income statement, never affecting net income until, when's it going to affect net income? When we're finally done, we move these from work in process to finished goods, and then we move them from finished goods to actually selling them, moving them to cost of goods sold. Now, we will sell it, sales will increase at the same time at that point, but what we're working on is the cost of goods sold that will ultimately be the cost. So all the stuff we're doing here is just kind of shuffling around on balance sheet accounts, just shuffling around basically on inventory asset type of counts to track this process as it goes through and being able to support the process with job cost sheets. In this presentation, we will take a look at an example of a time ticket and the recording of a journal entry related to labor for a manufacturing company, for a company using a job cost system. So when considering a time ticket, we want to keep in mind, of course, that when we track the time of workers that are going to be working on a job, we need to be able to apply it to a particular job. The time ticket here is going to be used for us to track the cost so that we know the cost of the job. Now, of course, we also, in a job cost system, would be tracking this out probably to help us to bill the job as well. They're going to be related in some way, but notice here, what we're trying to do is get to the cost of the job with the time ticket. Everything we're tracking here is the actual cost of the job. So when we consider the time ticket, then we're going to have, any employee that works on the job, and we're ultimately going to take their wages that we pay them, which we usually record as wages expense or something, or, hourly wages expense, to not an expense, but to the job, to work in process. So that's in essence what we're doing here. We're tracking the time. We're going to apply that time not to an expense at the period in which we paid the employee or even in which they worked, but to an asset, inventory, not expensing it until we sell the inventory in the form of cost of goods sold. So this is going to be a time ticket. We're going to have the employee here. We'll have the employee number if we have one. And then, of course, the job. That's going to be the important component, the job that we're going to assign it to. We have the similar punching in the time in, time out, the time that elapsed, the rate, and that'll give us the amount that we're going to apply to each job. Now, of course, this could be used in a computerized system. We could have an old time-taking tracker that we're going to have. So whatever way that we're going to use to format this, we got to make sure that whatever time we have, we're applying it out to the correct job so that we can then post this to work in process and have it be supported then by the job sheets. So here's an example of the job sheet. I'm not tying this ticket in directly to it, but it's just an example of a job sheet. Then this is a particular job that's going to support all the work in process accounts, everything that's on the work in process in a similar way as a subsidiary account by customer supports what's in accounts receivable. The job sheets are going to report what's on the balance sheet, what's on the trial balance for work in process. So in this case, we're talking about labor. So we're tracking labor here. So these time tickets are going to help us then to track the labor. We might have, if we're working a big construction job or something like that, we might have, multiple time tickets that we're going to have to track, and we're going to have to apply them to these job sheets. And note what's happening here again, when we record the journal entry, as we'll see, we're not going to record it to wages expense, meaning when we process payroll, we're in essence debiting not an expense, but inventory in the form of work in process, supporting it by the job. We won't expense it until we sell the inventory at the end of this process. So that's going to be what the time ticket function will be. And we need some format to do that. If we're doing a construction job, then we got to apply it out some way. If we have a bookkeeping company or a law firm, then again, we have to apply some way the wages out. Now, again, the billing is going to be similar too. If we had a construction company or a law firm or something like that, when we create the invoice, we might have a billable rate, which may or may not be the same as the rate that we're using to apply the cost to the job. But here again, we're looking at the cost. So we're looking at the actual cost, meaning, in other words, this looks a lot like an invoice. We may use this to create the invoice. We may take the bottom line number of actual costs as close as we can, except for the overhead, and mark it up. So we might say, now we're going to mark it up 30 or 40%, and that's going to be our sales price. Or if we're a bookkeeping firm or a bookkeeping firm or something like that, or a law firm, we might be tracking the time of our multiple employees. And on the invoice, we might be having a similar tracking, but we might use billable rates that are different from the pay rate in order to create the invoice. That might be a way that we create basically invoices. But here we're tracking the actual cost of the employees here because we're tracking the cost of the job. Okay, so if we then took this to direct labor and we took all of these labors that we're applying to these jobs, we took all the time tickets and we applied them out to the jobs. So we have a list of jobs now that we're saying all these jobs now are listed out, and we know that direct labor applied to them. In other words, we can think of it this way. If we're saying that the payroll for this time period added up to 5,000, that's what we have in payroll for these individuals, then we're breaking it out between these jobs that we paid for and this much is indirect that we couldn't apply to a particular job. So we're processing this now with a journal entry just like we would with payroll, meaning we're going to credit, we're going to say wages payable. In a simplified journal entry, it might be a credit to cash, right? But wages payable will show us that it's for wages because we're processing payroll. And then the debit, usually we would think, well, it's payroll, it's going to go to wages expense. And again, we're not getting into the withholdings and everything right now. There's a simplified payroll journal entry, and we're just going to say, well, the debit would normally go to payroll expense, but now we're going to say, no, it's going to go to work in process. Why is it going to go to work in process and not payroll expense when we're basically recording the payment of employees? Because the expense isn't there just because it's payroll at the time we pay them. It's an expense because we used that work in order usually to help us generate revenue in the same time period, the matching principle. Here, we use this labor not in order to help us generate revenue yet. It helped us to make inventory, which is work in process. It's part of the inventory. So the labor the wages that we're paying as part of inventory, we will expense it when we're going to expense it when we sell the inventory in the form of cost of goods sold. Then the other side, this is going to be the labor that wasn't applied to a job, meaning like supervisor salaries or possibly maintenance in the warehouse. We couldn't apply it to a job. So it just is going to go to indirect. So it's going to go, we're still going to go to wages payable because we're going to pay these people. And so it's going to eventually go to cash. That you can think of that as cash. We're going to pay them as well. It's going to go out of payable and then into cash eventually. And then the debit's going to go to factory overhead. So it's going to go to factory overhead. Again, it's not going to go to wages expense because we haven't used it. It's going to go to inventory eventually, and we're going to have to apply it out from factory overhead to inventory in some way. So if we look posting the journal entry to the general ledger, we've got the work in process here. So we've got the work in process was at 2,230. It's going to go up by the 4,200 to 6,430. That then is what we have here, 6,430. Wages payable. So here's wages payable was at 0. It's going to go up by 4,200. And again, you can think about it as if we were paying cash, right? So wages payable is just going to be an intermediary. If this was a very simplified transaction, it would just be a debit to the work in process, credit to cash. And that would be similar to us, again, just processing the payroll. We're not dealing with anything else like the withholdings or anything. We're just looking at a very basic kind of payroll journal entry. The main thing to note, however, of course, is that the expense here is not going to an expense. It's going to that inventory account. We also note that book problems will often use a payable account when working these types of systems because what they're trying to do is show us just with the journal entry without having to have a note in the journal entry that what this is related to. And if we just debit work in process and credit cash, then just by looking at the journal entry, we wouldn't really know what's happening. So we use the payable. Now, payable is fairly often used, but we might see it in some other areas where it's less, something like utilities. We might see a utilities payable or something like that, because that helps us to know that the part that's going into work in process is related to utilities in that case. And usually we wouldn't have a utilities payable because we would just pay the utilities. It would be a credit to cash. We might do it with a note. So just be aware of that. So we're just processing the payroll here. Wages payable. Then we have the factory overhead, 1,200. It was at 550. We're going to debit it 1,200 to 1,750. That's the amount in factory overhead. And then we've got the wages payable again, which was at 4,200. We're going to credit the 1,200 to 5,400. So now we have wages payable, which we will pay soon. When we do so, we will debit this, making it go down to 0, and credit cash. In this presentation, we will take a look at overhead costs. First, we want to take a look at the process for overhead, the process of recording overhead, the process of allocating overhead to jobs, it being a bit more complex than the allocation of direct labor and direct materials. First, we're going to set up a predetermined overhead rate. We'll talk more about the process for doing that, but this predetermined overhead rate will help us to assign what's in overhead to particular jobs. It'll help us move from overhead to particular jobs. We need to do it at the beginning of the process so that we can then use it in order to allocate overhead to jobs as we go through the current time period. We're then going to record actual overhead that we have during the process. Remember what actual overhead is. It's going to be the cost of anything that we can't apply to a job. So anything related to the manufacturing process that we cannot apply directly to a job, indirect materials, indirect labor, anything related to the warehouse that we can't apply directly to a job, like depreciation, like utilities on the warehouse, then we're going to put that into overhead. Then we're going to apply estimated overhead to specific jobs. Now note that these two may not be going in order. In other words, as we go through a time period, we're going to be incurring overhead as we go, meaning we're going to be paying for stuff, we're going to be paying the utility bill in the factory, we're going to be paying employees that are indirect employees that we can't apply to a particular job as we go. And we're also going to be applying the estimated overhead to jobs as we go. So we may apply overhead to a job before we record all the overhead for a time period. If we're talking about a month, then we may be applying some overhead to the job, of course, before all the overhead is recorded because the month isn't over. We're going to be incurring overhead through the entire process. We're going to be applying overhead through the entire process. What we want to do is set up the predetermined overhead rate so that whenever we need to apply, we can do so. And that is not necessarily dependent on whether we have recorded, the actual overhead or all of it for a certain time period. And then we're going to have to adjust the over or under applied overhead. So as we'll see, the estimate, this is going to be an estimate for us to apply the overhead to the jobs. It's not going to match our actual amount in overhead, the actual cost that we have. And therefore we will have a difference, which will be under or over applied, which we'll have to do something with just to deal with that estimate at the end of the time period. So here's going to be the process that we will go through. So first, let's think about the costs that we'll be dealing with. And note, I'm going to do this a little bit out of order because the costs that we deal with are going to be recorded and the actual costs will go together. And although we do this at the beginning, it's going to be applied directly to this process, us applying out the overhead. So first I'm going to think about the actual costs because that's probably how you would think about, how we would think about what would happen in terms of a GL account. We're going to have costs that will be incurred. We need to then allocate those costs to particular jobs. First, we'll think about materials. Now we're considering here the indirect materials. We've already looked at this at a prior presentation, but we want to just recap it here so that we know that here, as we focus in on the overhead component, we see it here as well. When we think about the materials leaving the materials account and going somewhere else, towards production, once we start working on stuff, you would think we want to apply it to a particular job. And this is going to be direct materials, things that we said, hey, we want, this wood if we're making guitars and we want to apply it to this particular job, and that's why. But if we have other materials, such as indirect materials like glue or something like that, that we're just going to say, hey, the warehouse needs more glue so we can work on more guitars, then we're just going to put that in the middle of the warehouse, and we're not going to assign it to all these guitars. We don't know which job it's going to be working on. So this account then is going to be indirect. So remember, we could have two accounts up here. Raw materials, we might try to track them differently. We might try to track the direct materials and then have another account for indirect. Or we might just group them all into raw materials. And then once we take them out, we reduce raw materials, as we'll do here. And we'll record the ones that we cannot assign to a particular job. We don't have a requisition form. It's just a request from the warehouse in general, or from the production department, the factory in general. Then we'll apply to overhead. So it'll look something like this. We'll say that the factory overhead is what we're going to apply to, and then the raw materials is going down. So raw materials will be decreased, but we're not putting into work in process because we don't know which job. Therefore, it has to go into the factory overhead. So it'll look like this. We're focusing on this journal entry. Factory overhead is increasing, going from 0 up by 550 to 550. And the other side is bringing down raw materials, which was at 147,770, down by the 550 to 147,220. So that's this account and this account. We moved it from raw materials not to work in process yet. We didn't know which job. We had to move it first to the factory overhead. We're starting to build up this account, and that's why I'm doing this first. We can see what's actually in there, and then we'll apply it out. So we're going to say, okay, now there's 550 in there. Where do we want it eventually? We want to eventually put it there. I just don't know how, because we cannot do that until we know which job to assign it to. So then the same thing was with direct labor. We already recorded this, but I just want to record it again just so we know where it is in terms of the overhead. So direct labor, if we're applying the timesheets, these are all timesheets that people that work in the warehouse, work in the production, in the factory, but these we can apply to a particular job. This is stuff that's in payroll that we could not apply to a particular job. So it's like the supervisor's salary, the maintenance, anything that's in there that's not working on a particular guitar in our case. We don't know which guitar to apply it to. It's going to apply to some of them, but we don't know which. So if we could apply them, this is part of the payroll that we applied. Up here, we're focusing in on this item that we cannot apply. And that's going to be going into factory overhead and credit wages payable. So again, this is like a payroll. This is like the payroll journal entry. We're paying someone payroll. We're not dealing with all the other withholdings and whatnot here. We're just going to say this is straight a simplified payroll journal entry. We're going to credit wages payable. You can think of cash. If we were crediting cash, we're paying somebody, and we're debiting factory overhead because they worked on the guitars, they worked on the jobs, but we don't know which ones. So we couldn't put it into work in process. So that brings us to this point. Now we have 1,750, and you can note as we build up this factory overhead account, we don't exactly know what it's comprised of. It's comprised of all these different things. Now we've got some indirect materials and some indirect labor that we are putting into this account. Eventually, we want it to go into work in process again, but we don't know which job to apply it to, and that's going to be our problem we'll have to deal with. Then we're going to have all the other stuff that is going to be included in the production of inventory that we don't know exactly which job it goes to. In other words, we're going to have indirect materials, indirect labor, and then we typically look at everything else that's not going to be part of materials and labor, and that's going to include anything that has to do with the factory. So in a book problem, anything that refers to the factory will typically be going to overhead as opposed to work in process. And anything involved in the factory as opposed to the administrative office, we can think of the two buildings being separate, then will be applied, of course, to the factory overhead as opposed to being a period cost, being a cost that we're going to apply to just expensing it typically. And these are the ones that actually can be kind of confusing because, again, all the stuff that we apply to overhead right now are stuff that we often think of as expenses. All the stuff that we're talking about, really, direct material. When we think about materials, especially when we think about wages, we often think of these are kind of expenses. We think of the debit side as being expenses typically. But that's really because of the matching principle, not just the nature of wages or the nature of the thing. So in this case, we're going to pick up anything that's going to be involved in the factory. We're going to include it in the inventory, but not to a particular job and therefore not to work in process, but to factory overhead. So if we had depreciation on the factory, on a factory equipment, we're going to say, okay, depreciation, what's normally the journal entry for depreciation? Normally, we credit depreciation expense and credit accumulated depreciation. And this time, however, we're going to credit accumulated depreciation still, but debit factory overhead. Now that probably looks really weird to many, when we first look at that and we've just probably memorized the journal entry that says depreciation is always recorded as a debit to depreciation expense, a credit to accumulated depreciation. And that's going to be recording the decrease in the factory equipment and the use that we've had over time. But why is that the case? Because usually the expense down here represents that we consumed something in order to help generate revenue in that time period. We're allocating the cost of the equipment to when we used it, consumed it. In this case, we used it, but we didn't use it to help generate revenue. We used it to make inventory, an asset. So therefore, we're kind of capitalizing. We're moving the use of that equipment to the cost of the asset. We will expense it when we finally sell the inventory in the form of cost of goods sold. So it's going to move to factory overhead. It's going to move to raw material. It's going to move to work in process, and then finally to finished goods. And then we're going to finally sell it. That's when we'll have it. And then anything else like rent, if it's rent on the factory or utilities on the factory or insurance on the factory, these are all things that we might think, typically we think of, an expense that we would have here. If it was rent expense, if it was rent on the office building and not the factory, then it would be an expense. But here it's going to be something that is on the building, so on the factory, and therefore overhead. So this is where book problems often will kind of make up an account. Instead of just paying something like the utilities bill, they might make up an account called like payable, utilities payable, just to show us that just through the journal entry that this deals with utilities. That's why they're doing it. But in practice, usually we would just pay cash. So in essence, if we add these up, our journal entry is basically 1,006 plus the 250 plus the 1,000. That's going to add up to 2,850. That's how much cash we're paying. Again, we probably pay with 3 separate checks here, but we're basically crediting cash for that amount. And then the debit, we would normally think, well, the debit should go to rent paid or rent expense, utilities expense, and again, if it was monthly, to insurance expense or prepaid insurance. Here, we're going to say, no, we're paying these not in order to help generate sales in the current period. We're hoping it's going to help generate sales, but not until we sell the inventory sometime in the future, and therefore the debit's going to go to factory overhead. So we're going to put this into factory overhead, and again, it's going to go up here. We are going to expense it, but not in the form of, we're never going to see utilities expense on the factory because the utilities expense is included in the inventory. And when we expense it, it'll be in the form of cost of goods sold, which is an expense, not in the form of utilities expense. So any utilities we pay on the administrative office, we'll expense them because we use the administrative office in order to help us generate revenue. It's a period cost. Any utilities expense on the factory, however, is going to be part of the inventory, which we'll put in the factory overhead. We're going to allocate finally to work in process. We'll finish that inventory and then we'll sell it, expensing it in the form of cost of goods sold. So if we look at these journal entries, then we're going to debit factory overhead. Here's factory overhead. It was at $1,750. We're going to increase it by $2,500 to $4,250. We're going to credit accumulated depreciation, which was at $1,053, crediting it, making the contra asset account, the credit balance account, go up by $2,500 to $1,055,500. That's what's on the trial balance. Then we're going to debit factory overhead by the $2,850. So here's the $2,850. So the $4,750 going up by $2,850 to $7,100. That being represented on the trial balance. And then the cash is going down from $418,000 by $2,850 to $451,50. And that is going to be what's on the trial balance. So in essence, we're recording these, which again, normally we would think of as kind of expense type of transactions if it was a service company or a merchandising company, but because it's on the warehouse, not on the warehouse, on the factory, because it's part of the factory process, it's going to be included in an asset, capitalized as an asset, first in factory overhead, because we don't know which job to post it to. We don't know where to post it to in job. If we did, it would go to work in process, but we don't know which job to apply it to. So we're going to first put it into this bucket. So this bucket now, factory overhead, has all this stuff in it. Everything we think that should be included in the cost of inventory, but we don't know which inventory. Everything that should be included in the cost of a guitar, the cost of a construction job, but we don't know which construction job is here. Then we're going to allocate it some way. So we're going to have to use some basis to allocate this out. And how are we going to do that? Why can't we just allocate it evenly? Because we have goods that are not the same. All of our stuff is different. If we have construction jobs, all the jobs are different sizes. Wouldn't be proper to allocate, this cost evenly to the jobs because all the jobs are going to be different. So we have to basically estimate how much to allocate. And that's going to be our future project. In this presentation, we will allocate overhead to jobs using a predetermined overhead rate, which we will see how to calculate. First, we want to take a look at the overhead process, the procedures that the overhead will go through in order to record the overhead and then allocate the overhead. The first thing we're going to do at the beginning of a time period, at the beginning of a month or period, is to set the predetermined rate. Then we're going to go ahead and record the actual overhead that we are going to incur, and then we're going to apply estimated overhead to specific jobs. Now note that these two don't necessarily happen one after the other, but it's useful to think of them happening one after the other because it's useful, and that's how we've presented it here. We've taken a look at the recording of actual overhead so far because we can think of that being the issue. We're going to have the overhead that we're going to incur, indirect labor, indirect materials, and all the other stuff that's going to be in the overhead bucket, which we're then going to have to apply in some way to the jobs. Now, as we go through the month, however, remember that these two things are kind of happening at the same time, meaning we're incurring overhead costs all the time. Anything that's a cost in the factory is a form of overhead cost, and we're working on jobs and therefore applying the overhead all the time. So we first need to do at the beginning of the month is really set the predetermined overhead rate so we have it at any given time. Anytime we have a job, we can't really wait to know what overhead's going to be at the end of the month. That's not something we can do. What we need to do is look at some type of estimate from the prior time period and estimates going forward. So we're probably going to use information from the past and basically projections in the future to determine what the overhead will be and use some type of rate, some type of estimate that we're then going to use to apply out the overhead as we go. Because we can't apply out the overhead on the actual numbers here because the month isn't over yet. And until the month is over, we don't really know what overhead is going to be. So we have to use this estimate. So we need this estimate kind of at the beginning of the month. We need to project the estimate. And then we're going to record the actual overhead that we have within the overhead. But we're also going to apply out as we go through the month, as we get new jobs. We're going to apply overhead out as we go. And then we're going to have the adjust the under or overhead, because this is an estimate, because we're going to make here a predetermined overhead estimate and apply out the overhead to jobs based on that estimate. And then we're going to have an under or over applied amount, and we're going to have to deal with that in some way. We'll have some type of adjusting entry here. So at this point, we're really looking to set the predetermined overhead rate so that we can apply out the estimated overhead. And I wanted to put these two together because although this is done first, typically I want to have these two together because they kind of apply to each other. We want to set the rate in order to apply out the overhead to jobs. So we're going to set the predetermined overhead rate. So the predetermined overhead rate formula is simply going to be the estimated overhead cost divided by the estimated activity base. So first, what does that mean? Estimated overhead cost. What we would like to do is have the actual overhead cost, of course. But if we're talking about this month of operations, we don't know what the actual overhead cost is going to be. And, we might be able to say what it is up until this point. It might include indirect materials, indirect labor. Some of the stuff might be in there, but it's not going to include those things like depreciation, which we don't record until the end of the month. It's not going to include like utilities on the factory, which isn't in there till the end of the month. Those things need to be allocated out as well. So we can't really use the actual cost because we don't know what it is till the end. And we have to start tracking costs because we need to keep the costs tracked as we go. So then we need an estimate. So what we're doing is basically saying, what do you think total overhead will be as of the end of the month? What will total overhead be as of the end of the month? And we want to predict what it will be so that we can use that to allocate out. Usually we'll start with last month probably, and then we'll try to project as to whether we're going to have an increase or decrease based on future events. So anytime we have an estimate, it's probably going to be starting with past data, and then we're going to look at what's going to change in the future, and we're going to come up with estimated overhead. So we're probably going to add up all the stuff that went into overhead last month, all the indirect labor, indirect materials, all the other stuff, and then try to adjust it to what we think will be adjusted for this month and come up with our estimated. Then we're going to divide by the estimated activity base. And then what is that? What's an estimated activity base? Now, this is based on the idea that we need something to tell us how big one job is to another. So, in other words, if we had just, if we think we're going to work on 10 jobs, why can't we just take this number, our estimated total overhead, and divide it by 10? If we have 10 construction jobs, we can just divide it by 10 and allocate that. And it'll be an even allocation to how many jobs we think we're going to have. But we can't really do that because even if we knew that we were only going to have 10 jobs, the jobs are all going to be different in size. That's the whole point of a job cost system. They're not the same size. So how do I allocate more cost to a larger job and less cost to a smaller job? And how are we going to do that? So to do that, we have to see some kind of factor that's going to tell us how relatively large one job is to another. And that's going to be the activity base. So typical activity bases, for example, is going to be like direct labor or possibly the amount of material we use. So in other words, if we think about how much labor was used in a job, whether by cost of labor or by hours worked on the job, those are going to mean that more labor is going to be worked on larger jobs and less labor on smaller jobs, typically. And therefore, we can use that as some kind of ratio, to know how much of the overhead then we should allocate. We should allocate more overhead to the job that has more labor cost to it because the job that has more labor cost is probably larger and therefore deserves more overhead, which was probably actually used in the job. And we could have the same rationale for materials. If this job used more materials, then it's probably a bigger job and it probably has more overhead that should be allocated to it. So what we're using is some type of activity base, either direct labor or direct materials typically, and we're going to use a ratio to help us allocate this. So we're going to say this is the estimated overhead divided by whatever activity base, and then we'll use that to allocate. So let's see what that looks like. We're going to say that our predetermined overhead rate is going to be 1.6. So let's see what that means here. Now we're going to take the direct labor that we had calculated by job. This is the direct labor that we have applied directly to each of these jobs, and we're going to use that to apply out the overhead using the estimated overhead or the predetermined overhead rate we determined to be 1.6. So note that this predetermined overhead rate can be given to the total here, meaning if we look at the direct labor for all of the jobs, we've got the 4,200 summing up all the jobs. We can take that, of course, and multiply it times the 1.6. So we can take the 4,200 times 1.6, and that'll give us the 6,020. And we can multiply each one of these jobs to give us a total for each job that's going to total up to that 6,720. And so that's going to be the total. Now it's important, this number here is all we need to make the journal entry, because the journal entry, what we're going to do is we're going to be moving this from the overhead account to the work in process account. But we need this worksheet in order to tell us how much of that overhead should be applied to each job. So remember, every time we transfer something to work in process, it needs to be supported by the jobs, and this will be the worksheet to do that. Also remember that although we're using direct labor, the overhead has nothing to do with direct labor. The overhead is just using direct labor as a means to tell us how big one job is in relationship to another job. It's just basically a ratio analysis that we can think of. Basically, we're basically saying, this particular job is 1,200 of the total divided by the total 4,200. It's that percentage. If we take that percentage times the overhead, we would take this times the 6,720, this number here, that's going to give us the 1,920. So we're just using the relative ratios in essence here. That's what the predetermined overhead rate is based on in order to allocate the proper amounts to these based on relative size of the job, relative size being determined by the direct labor that's being applied to each of them. Now note that we could see this actually on the job sheet as well. So this is job number 15. This is just an example job sheet. But just note that we could see in the overhead section, every job sheet is going to be allocating the cost being direct materials, labor, and overhead. And we could note on the overhead here that it's going to be 160 or 1.6 of the direct labor. And so these numbers on this particular job cost sheet are just taking this number times 160% or 1.6. And we could sum those up as well. Also note again, this looks like an invoice. It's not really an invoice here, but an invoice could use this as a basis to it, meaning this would be the cost. This is the actual cost to us of the production of the inventory. We might use this and say, well, we mark it up 30 or 40%, and that's how we come up to the cost. So if we had a job cost in terms of construction, that would be a fairly transparent way to do this. We'd say, hey, this is how much direct material, this is how much direct labor, this is our overhead, this is the total cost. We're going to mark it up, 30 or 40% or whatever our markup is. That's the revenue we get. That's one way that we could construct an invoice, and that would be based on this information. Note that the overhead, no matter how you look at it, is going to be the most difficult thing to explain, because people are going to say, well, you took the direct labor and multiplied it times 160 and charged me for direct labor twice. It seems like you charged me 3 times, 2.5 times for direct labor or something like that. And it's like, and the response to that, of course, is no. The overhead is not anything to do with the direct labor. The direct labor, again, is just used as a ratio. It's an estimate for us to allocate out the overhead to jobs based on relative size, based on how much labor is being used in them. Okay, so if we take a look at the journal entry then, we're going to say that the work in process is going to be debited, increasing the work in process. We're basically moving this information from the factory overhead to the work in process. So work in process has a debit balance. We're going to increase it with a debit because the inventory is increasing. Note that the debit is not for 7,100. And you might ask, well, why isn't it for the amount that's in factory overhead? And the reason for that is, one, we wouldn't know this number again until the end of the month. And so as we do this allocation, we may do this allocation multiple times for each job. And so we wouldn't know exactly what's in factory overhead. Therefore, we had to make an estimate. The estimate is never going to match what actual factory overhead is. It can only be close unless we were perfect, which is unlikely. So it's always going to be somewhat off here. So we're gonna put it into work in process, and we're gonna take it out of factory overhead. This being an inventory type account, an asset account has a debit balance. We're gonna decrease it, doing the opposite thing to it, a credit. So we're moving it from here to here, from one inventory account in essence to another. Whenever we move something to the work in process account, it needs to be able to be supported by the jobs. If we post the journal entry, then we're going to say that the work in process account here is going to be debited in the GL. So the GL for the work in process was at $6,430. It's going to increase by that $6,720 to $13,150. So that's what we have here. And then the factory overhead is going to be credited, decreasing it. It was at $7,100. It's going to go down by $6,720 to $380. That's what's left in factory overhead. Now we're going to say that for this particular month, this is all the activity in factory overhead. So we've done all we've allocated all the costs, the actual costs to the factory overhead, or we've actually incurred the actual costs and recorded them, and then we've allocated those costs out to work in process and to the related jobs in order to allow us to allocate to the work in process. Remember that the work in process account needs to be supported not only by a GL account, but actually by the jobs as well. And that's why we couldn't post directly to work in process when we incurred these costs, but had to put them into the factory overhead and then use this allocation method to know which jobs we can apply to, so that we can do this kind of lump sum journal entry. This lump sum journal entry is going to be supported by, backed up by job cost sheets. In this presentation, we will take a look at the journal entry for under or over applied overhead. First, let's take a look at the sequence of events related to overhead. Generally, at the start of the period, at the start of the month, we set up the predetermined overhead rate. That overhead rate, the thing that we will use to allocate the overhead from the bucket of overhead to individual jobs. Throughout the month, then we're going to record actual overhead, the actual things that we're going to put into overhead. Remember that those things are the things that we cannot apply to a specific job in a job cost system, and therefore we put it into overhead and are going to apply it to a job using an estimate, that estimated being the predetermined overhead rate. It's going to be part of the estimate process. Then we're going to apply the estimated overhead to the jobs. Now note that here we have these two items are happening. One, we have the recorded overhead, the actual overhead, and then we have the applied overhead. And of course, because the recorded overhead or the applied overhead is an estimate, it's not going to match the recorded overhead. So we're going to have then this problem of over or under applied overhead. And it could be either one. We might have over applied or under applied. Whatever is the case, we're going to have to then deal with that over or under applied overhead by the end of the time period, so that next month we basically start with zero. So there's three things that can happen with an estimate. One is, we could be under applied, we can be over applied, or we can be right on. Our estimate could be perfect. That's not going to happen in real life. So we're almost always going to be under or over applied, and we'll have to compensate for that in some way. In our problem here, we see that overhead was underapplied by the 380. We have the 380. Now we need to know the terminology, and we also need to know what to do with this 380. And they're often two different things, because obviously what are we going to do with this 380 at the end of the time period? We're going to make it zero, whatever it is, whether it be a debit or a credit. We're going to make it to go to zero because we need to start this process over in the next month. So although this factory overhead is kind of like a permanent account, it's kind of like part of inventory, it's acting like a temporary account, not because it's closing out to retained earnings, but because we're going to close it out to basically cost of goods sold. We're going to force it to go back to zero so that we're going to start all over in the next time period. And the reason so that means that this number here, the 380, whether it be a debit or a credit, from a journal entry standpoint, we're going to do whatever we need to do to make it go to zero. So this is a debit, so we're going to credit it 380. If it were a credit, we would debit it by 380. So from a practical standpoint, that's all we need to do. We need to see what's there, and we need to do whatever we need to do to make it go down to zero at the end of the time period. From a book problem perspective, and just from a communication perspective and knowing what's going on, we need to understand the terms under or over applied. If we look at what actually happened in factory overhead, we're going to say, okay, this is the stuff, all the debits that happened. That's the stuff that's going into factory overhead. And you can think about this by thinking about, okay, what would the debit journal entries be related to factory overhead? When would we debit factory overhead? Let's think about the journal entries. Well, one would be indirect labor. And so the indirect labor would be crediting wages payable or cash and debiting factory overhead because we didn't know which job to assign it to. And we're not expensing it because it's not part of this period's cost. It's part of the inventory. Indirect materials is going to be the same thing. We took materials out in order to make inventory. Didn't know which job to put it to, so we debited factory overhead and credited the raw materials. Any other thing that's on the factory that we paid for, such as rent on the factory or utilities in the factory, those are going to be things we're going to credit cash, and we're going to debit not the expense of utilities expense and whatnot, but part of inventory, not work in process because we don't know which job to put it to, but factory overhead. So all these debits are what actually happened. And then this credit is us taking it out. If we think of that journal entry, that's us reducing the factory overhead with a credit and putting it into the work in process. It's only one journal entry here and going into just the work in process account there, but it's going to be going to multiple jobs that support this work in process account. And that's why we had to do it in this process. That's why it had to go in and out of the factory overhead in the first place. Now, as that happens, we can say, okay, well, and also note that this amount that we apply out, we did it all at one time to all the jobs at one time, like at the end of the month. It's quite possible that we do that as we go, meaning we might start the job and as we finish the job, apply out a factory overhead as we finish the job. So we may have credits in here as we go. It's not always the case, in other words, that we will incur all the factory overhead and then apply it out at the end of the time period. We're going to apply it out based on our predetermined overhead rate as we go. So we want to keep that in mind. But as we look at this at the end of the time period, we can say, okay, well, these are the debits. There's the credits. There's more debits than credits because we're left with a debit balance. In other words, the debits are winning. If I add up all the debits and subtract out all the credits, the debits are winning by 380, meaning we had more actual costs than we applied out. And that would mean that from our terminology standpoint, that's going to be underapplied. So we have underapplied because we had more costs than we applied out. We applied out less than or under what the actual was. Now that leaves us with a debit balance, which kind of makes sense for us because it's always a debit balance. You would think factory overhead being kind of like an inventory account would always be a debit balance. But it could have been overapplied. And overapplied would look funny to us because it would mean that this credit here had been higher than the debits. And that's possible. It would just flip the account from a debit balance account to a credit balance account. So if the credits were winning, we would have a credit balance in the factory overhead. And that's okay because it's just an estimate. It could be overapplied. It could be underapplied. We don't know. We do our best to make an estimate as close as possible. And it's possible to be under or over. Whatever the case may be, we need to do something with this 380. We need to make it go down. In this case, it's a debit. We're going to make it go down doing the opposite thing to it, which is a credit. Now, the other side we're going to put that to is like, where are we going to go with that, the other side? Because we don't know which job to put it to. That's the whole process. That's the whole problem of us putting into factory overhead in the first place. And we're going to use, as we can see here, the cost of goods sold number. And our rationale for that is basically going to be that eventually it's going to go to cost of goods sold. Because if we go through this process, we would hope it's going to go to factory overhead. It would, if everything was done perfectly, it would have then go into work in process, and then we're going to sell that, and then it's going to go into finished goods, and then we're going to sell this inventory and expense it in the form of cost of goods sold. So this 380, we don't know where it really should be. Should it still be in work in process? Should it still be in finished goods? Or should it be in cost of goods sold? It could be in either one of those if we had done things perfectly, if we knew exactly where to post everything out. Why then would we choose cost of goods sold? If it's immaterial, if it's small amount in relation to decision making, cost of goods sold is the easiest place to go, because cost of goods sold will then roll out to net income, and then net income will roll out or roll into retained earnings. In other words, it'll go away after this first time period. So that's the easiest thing to do. If we want to make this 0 and not have to worry about this number, then we can put it to a income statement account, the most logical one being cost of goods sold, because it's related to inventory, which will then roll out to retained earnings at the end of the time period, and we won't have to worry about it. We'll start all over. So again, the question here often is, well, what happens to net income? You're distorting net income possibly by this 380, because maybe it shouldn't be in cost of goods sold. Maybe it still should be in work in process or finished goods. And that could be the case, but usually and hopefully it's immaterial to decision making, and it won't affect people's decision making process, and therefore it's okay, it's justifiable to do the easy thing and write it off to cost of goods sold, given the fact that it is an estimate. Now, if it is material, then we would want to go back through. If it's going to affect decision making, if this is a big number in relation to the other numbers that would affect what we think about the financial statements, then we'd want to go through and say, okay, we should go back and try to figure out which job it should be applied to. Is it still in work in process, finished goods, or have those jobs been sold, and try to allocate in some fashion to the jobs and properly allocate it out as best we can. Again, there's no perfect way because it's an estimate. This bucket is just an estimated number. So we can try to do a reallocation and figure out where it should go if we think the number would be material. If not, we'll do the easy thing here and just record it to cost of goods sold. So that's what we do here. Now, note also that if this number happened to be a credit, then we would just do the opposite of this journal entry. Meaning we would, if this was a credit here, we'd have to do the opposite thing to make it go down. We would debit it, and then we would credit cost of goods sold. And that might seem a little funny, because you might say, why would we ever credit cost of goods sold? And because it's an expense account, it should only go up in the debit direction. And again, it's not about cost of goods sold. It's really about just getting this number to 0. We already know this number's wrong. It's only wrong because it's an estimate. If it's close enough, then that estimate is close enough. And all we're trying to do is make this 0. And we're kind of abandoning the normal rule to cost of goods sold, which is that it typically only goes up in the debit direction. In this case, we'll make it go down just to clear out this account here. And because it's low, it's a low amount. So that's kind of our exception to the rule that I have said a few times, that expenses typically only go up. So there's a few exceptions to the rule. This would be kind of an exception to that rule if this amount happened to be a credit at the end of the year, meaning we had over-applied factory overhead. We would do the same journal entry, but of course the reverse of it. To make factory overhead go down, we would have to debit it, and then the other side would have to go to cost of goods sold. We're not going to change the account it's going to go to, and it would look funny because we would be crediting cost of goods sold, but again, that's okay because it's just an estimate. Okay, so if we do that, then our journal entry is going to be a debit to cost of goods sold, going from 0 up by 380 to 380. And that's going to be this posting. We're posting to the general ledger. Then we're going to post the factory overhead. It's going to go from 380 down in the credit direction, in this case, to 0. So if we look at our accounts over here, we've got the factory overhead at 0. That's the point. And then we have the 380 here, which brought net income down. Now, in our problem here, we haven't recorded the sales for the month yet. So the sales are going to be recorded in the next process. We wanted to keep the factory overhead journal entries kind of in the same place, so you can see them side by side what happens. So remember that this really happens at the end of the time period. Generally at the end of the month, we would clear out the factory overhead. And that's going to be after, typically, hopefully, we're going to have sales happening throughout the month. What we're going to record now is the next process that's within the flow of inventory, which is to move the work in process in the next presentations to the finished goods and then some of those jobs will be sold, recording sales and the cost of goods related to those jobs. In this presentation, we will enter a journal entry to record finished jobs, moving those finished jobs from the work in process account to the finished jobs inventory, finished goods inventory account. Recall what we have done so far is record the processing and the production of our inventory, most of that happening in the account called work in process. That work in process account, this one number in work in process being supported by jobs. So this one number needs to be supported in a similar way as the accounts receivable. The accounts receivable having a GL account by date, but also needing a subsidiary account by customer to know who owes us money. The work in process also has a GL account by date, but we also need to know this work in process by job. So as we recorded costs that are going to be applied to inventory, we either applied them to the work in process directly if we knew which job it was going to, such as the direct materials and the direct labor, or we had to allocate it to the jobs after first recording it into the bucket of overhead, then using a predetermined overhead rate to allocate the overhead to the actual jobs. What we're showing here is going to be a bit of a condensed job cost sheet. So we have like these condensed job cost sheets, job B15, B16, B17s up here, B18, and B19. They all have the three major components. We've got the direct materials, direct labor, and factory overhead. And if we add those up, these three components for each job, we will get to the totals here, the total for each job. So this is the cost of each job as we go. This is the cost so far. Now, when all those jobs are open then, as they have been so far, we're going to say that they're all in work in process. We don't have anything in finished goods so far. And so all of these jobs at the start of here were open jobs. They're all going to be comprised of or put together to come up to the 13,150. In other words, if we add up these jobs, we're going to say the total job cost is 3820 plus 2790, which is this item, plus 2024 plus job B17, which is 2126, and job B18, which is 2390. That's going to give us our 13,150. So that's the case when they're all open. Now there's three basic ways a job can be. It could be open and we're still working on it, which means it's going to be in work in process, or it can be closed because we're done with it. So I'm going to call that a closed job, a finished job, a completed job. However we want to phrase that, we're going to say it's completed, and therefore it needs to move from the open job to the completed jobs. And we're going to say that these three in blue here are those that have moved. We're going to say they still have a job cost sheet. The job cost sheet looks much the same, but it's done. We're no longer working on it. We're no longer adding more material, labor, and overhead costs to it because it has been completed. Whereas these two jobs, B18 and B19, are still open. So what we need to do then is make a journal entry for that transaction to move this to here. The journal entry is pretty straightforward because these are two inventory accounts. We just need to move this to here, but we need to be able to support that by the job sheets. And that's what gets a little bit tricky, because we're going to be using these job sheets to back up and support both the work in process and the finished goods. So the journal entry, according to the numbers we have here, we're going to say, okay, these three blue jobs we're going to move. So that's going to be the 3820 plus the 2126 plus the 2790. So that's going to be these three items here. And we're going to move those out, and we're going to put those into finished goods. So let's do that now with a journal entry. Before we do, however, just want to remind us of what the full job cost sheets that we've been looking at have looked like. So we're kind of simplifying these job cost sheets here to give us a simple worksheet to work with. A job cost sheet that we have been looking at might be more detailed depending on what types of job cost systems we're running. But they have the three components: direct materials, direct labor, and overhead. And again, we might be applying that direct labor out with the requisition forms and the time tickets and tying that information out. But in essence, of course, we're going to end up with total direct materials, total direct labor, and overhead, those being our jobs. And then we're going to pick those jobs as we did here. See, we only have basically the totals in this little worksheet. We'll take the totals here, pick the jobs that are open, the jobs that as they close, and allocate them out in this process. So here we've done this. We're gonna say, remember that our amount is $8,745 for these 3 blue jobs that we're gonna move out. And then the journal entry is pretty straightforward. We're just gonna take them out of work in process. This is a debit balance account. We need to make it go down, and therefore we'll do the opposite thing to it, a credit. And we're gonna put it into the finished goods inventory. This is also another inventory, which is an asset balance account. It needs to go up, so we're going to do the same thing to it as its normal balance, which is a debit. So we're going to go ahead and debit the finished goods inventory for that $8,736, the sum of these 3 jobs. And then we're going to credit the work in process for that $8,736, just moving that number from here to here. Again, the difficult part being us making sure that we have the correct supporting documentation with the jobs to support both the work in process now and the finished goods accounts. So we're going to post this now to the general ledger. So here's our finished goods. We're going to post this out. It's going to go from 0 up by 8,736 to 8,736. That then is found here in our trial balance. So here's our ending trial balance so far. And then we have our work in process. We're going to credit it. So it was at 13,150. We're going to credit it by that 8,736, moving it out and down to 4,114. And that, of course, is the amount we see here on the trial balance. So now we just broke this number up between, in essence, those two, breaking out the ones that are finished goods based on the jobs that had now been completed. So if we look at our end product now, we see the job cost system is now supporting these 2 numbers. And just to verify that, we said that the blue numbers are now the finished jobs, which once again is the 3820 plus the 2790 plus the 2126. That's going to be this number, and this number adds up to this 8,736. And the jobs that still remain open then are also supported by these 2 numbers, 2390 and the 2024. So that's going to be these 2 open jobs, and that's going to be represented by the work in process account here. So now both of these accounts are being supported by our job cost sheets. The next step, of course, is that we're going to sell some of these, and that step will be similar to a merchandising company in that we'll finally have these finished goods inventory. You can think of these jobs as basically finished goods, like inventory. This is the cost of them now. In finished goods, and we can just, when we sell them, have the normal journal entry, and we'll see that next time. Just to note, however, when we do sell it, we often forget about and get confused in the sales half of the journal entry and the cost of goods sold, because we've been focusing so much on the cost that we're actually focusing in, when we sell it, on the cost of goods sold component. The sales component, everything we're tracking here has nothing to do with sales yet. We may use the job cost sheet for sales, but these job cost sheets don't have anything to do with sales, and therefore they're not related directly. So in other words, we may, for example, use our job cost sheet as our construction of our invoice and say, our invoice, look, we had this much in direct materials, this much in direct labor, this much in overhead, and we may tell our customers that we have like a 30 or 40% markup, and say that the sales price then would be 2390 times a 30% markup, 0.3, plus the 2390, and charge then 3,107. That's one way we could construct the invoice, but it doesn't necessarily have to be constructed that way. And when we do the journal entry, there's 2 sides to it. There's going to be debiting accounts receivable or cash and crediting sales. That side having nothing to do directly with these numbers. And the other side being debiting cost of goods sold, crediting the inventory, in our case, finished goods inventory. That journal entry should look familiar if you've worked with merchandising companies. But again, since we haven't been looking at that journal entry the whole time and have only been focusing in on cost and not revenue side of things, we can get confused on that journal entry. So that's what we'll do next time. In this presentation, we will record the journal entry to record the sale of jobs, the related reduction in finished goods inventory, and cost of goods sold. What we've done so far throughout the period is we're recording the costs related to the inventory into the work in process account, and then we transfer them to the finished goods once they're completed. In other words, we're recording the information into the work in process account as they happen, as the costs happen. The ones that we can assign directly to work in process, that including the direct materials and direct labor, then we include in work in process. We can include them directly only if we can assign them to particular jobs. So direct materials and direct labor are items that we can assign to jobs such as job 15, job 16, job 17, job 18. The stuff that we could not assign directly to the jobs, we had to put into factory overhead, then use an allocation base to assign it to the job. So each job then does have factory overhead, but we had to use an estimate in order to apply out this factory overhead. So now we got to consider, are these jobs open? Are they closed, or have they been sold? There's really only three things that could happen to these job cost sheets. They could either be a job that we're still working on, in which case I'm going to call it open, it's still being worked on, or it's been closed or finished, whatever we want to call it. I'm going to say closed. Then it's going to be a job that should be included not in work in process, but in finished goods. And then once we sell it, I'm going to say it's going to be shipped at that point. So that's when it's going to be shipped or done or completed. It's not only done in terms of the finished goods is done, but it's done in terms of it's gone. We shipped it, it's left, and therefore should be recorded in cost of goods sold. Now notice what we're not focusing in here. I'm not focusing on the sale, because the sale is going to be recorded at that final point when we ship it. But that sales price doesn't have anything to do directly with these numbers on the cost sheets that we're directing, but the cost of goods sold does. So we'll talk more about that when we record the journal entry. Right now, just note that this current job sheet is supporting work in process finished goods before we record this shipment, meaning it still has these two in finished goods. So if we look at the supporting documentation for the job cost sheets, we're going to say that these three add up to, if I add up this 3,820, the 2,790, and the 2,126, we're going to say that the 3,820 plus the 2,790 plus the 2,126 adds up to the 8,736 that's still in finished goods inventory. Our goal now is going to be to ship these two out and move them from finished goods. They got to go out of finished goods because we don't have them anymore, and they're going to move to cost of goods sold. That journal entry then is going to be for these two jobs, 3,820 plus the 2,790, or 6,610, that we're going to reduce the finished goods by, leaving just the one finished good job, 2,126, and moving this 6,610 to an income statement account, a temporary account, one that will close out at the end of the time period to retained earnings of cost of goods sold. The two jobs that are still open, that are still in work in process here, are these green jobs. That's going to be the 2,024 and the 2,390. So the 2,390 and the 2,024 add up to the 4,414, which are still in work in process. So these job cost sheets can then support the work in process and the finished goods. They will, in essence, support the cost of goods sold to a degree, but remember that these are temporary accounts that will close out to retained earnings. So as we go through time, as we go through years, we're going to have a whole lot of closed jobs that have been closed and shipped, hopefully, because we're going to be doing this for a long period of time. The cost of goods sold number is going to always close out to retained earnings. So we can't really tie it out in the same way, the same fashion, as we can tie out to the finished goods and the work in process accounts. So just keep that in mind. Note that we are looking at kind of a simplified job cost sheets here. The job cost sheet that we've looked at as an example is more detailed here. We have the direct materials, direct labor, and overhead, the three components of which will always be in the job cost sheet. This showing more information as we go, including the requisition forms and the date of the direct material requisitions, as well as the time tickets and the date of the time tickets being allocated to this particular job. So this is just an example of one job that could be more detailed, and we're kind of summing this up: direct materials, direct labor, and overhead. So just keep that in mind as we go. The job cost sheets might look different. They could be very detailed. We could have a simplified format of them. Different companies will have different job cost sheets. It'll depend on what type of work we're doing, but they will all typically have, if we're making stuff, direct materials, labor, and overhead. And if we're not making stuff, then we're basically typically going to have the labor. We're probably charging for hours, and we could still have the overhead that we're going to allocate out. Okay, so then if we then take a look at the journal entry, it's a little bit more tricky for the sales journal entry, because what we're doing now is saying these jobs have been shipped. So we know that the finished goods inventory needs to go down because we no longer have these items, and we have to tie out the job cost sheet here. And the other side is a little bit more tricky. We might say, well, what should the other side be? And you might be tempted to say, well, it should be sales, because that's what happened. We made a sale. But and we have to go back to that merchandising journal entry to figure this out. And when you think of a merchandising company or any company that sells merchandise, and it's a perpetual system, there's two things. We can think of them as two journal entries. They happen at the same time. We could record them as one journal entry, but it's useful to think of them as two journal entries that happen at the same time, happen simultaneously in a perpetual system when we make a sale. One is that we credit sales, increasing sales, and we debit, if it's an invoice, accounts receivable, or if we get the cash at that point, cash. So that's going to be one component. Now, based on what we have here, we don't know the number yet of that. We only know what the journal entry is going to be, because all we're tracking here is the cost. What we're tracking here is the other side, which is to decrease the finished goods inventory and record the related expense of cost of goods sold. That's what we know so far. We know that this is going to be cost of goods sold. The cost of goods sold is comprised of these two jobs that have been completed. This job at 3820 and this job at 2790, giving us the 6,610. So that's what we know so far. We don't know the sales number, but we know it's probably going to be more than that, hopefully. We don't know exactly what it is. And then we're going to credit the finished goods. So the finished goods is going to go down. So if we think about the sales number, then a book problem will often give it to us. In practice, we would have to determine, of course, what our sales price could be. If it's a construction company, we may have set a bid at the beginning of the process and now complete the bid. Or we might have set the price at the beginning of the process, and we may use the job cost sheets in order to determine what the price will be. For example, if we were doing like a construction company or any type of job cost system, some kind of transparent system, the most transparent way to do this would be to set up an invoice saying, hey, look, this is what we actually think the job 15, the one we worked on with you, was for direct materials. Here's the direct labor. Here's the overhead, which is us allocating all those other costs that are like in the bucket that allocates out. That adds up to 3,820. And then tell our customer what we mark up for. What's our revenue proportion to this? If we say that there's a 30% markup for us, for our revenue, we would say that it's for this job, 3,820 times 30%, 0.3. That's how much we're going to earn here, plus the cost, 3,820, or we're going to charge 4,966. Or we can do that with one calculation. That's going to be the 3,820 times 100%, 0.3, 30% markup. So that's the 4,966. So that's one way we could make the invoice, which is a nice way to do it, transparent way to do it oftentimes, but it's not the only way we could make the invoice. The sales price is not tied directly to these sheets unless it's whatever we plan to do with it. So if we have these two jobs, then our journal entry for these two jobs, if we have a 30% markup, that's what we're going to assume here, is 3,820 plus 2,790. That's the cost of those two jobs right here. And we're going to mark that up 30%. So I'm going to say that times 1.3. So we're going to sell them for 8,593 then. That's how much we're going to invoice for. So then we're going to say that the receivables is going to be that $8,593, and we're going to credit the sales for $8,593. Again, if you look at a merchandising company, you probably think of this journal entry first because we're concentrated on the sales all the time. So what's the sales price? And then we'll think about the cost of goods sold. Here, like, book problems may not even ask you for this journal entry, even though it's the thing we're most focused on in practice because we're focused on, earning revenue, getting money. But this whole problem has been focusing in on this journal entry, this component of it. So just be aware that when we get to this last step, that we have to figure out the sales price, and it's not tied directly here. A book problem is going to have to give it to us. In practice, we will, of course, have a system of determining what the invoicing price will be, and it may be based on these job cost systems, but not necessarily directly applied to them. So now we will record the journal entry to our general journal. So here's the accounts receivable. It started at 180. We're going to bring it up in the debit direction by 8,593 to 188,593. That then found on our trial balance. Then we have the sales here. So the sales was at 0. It's going to go up in the credit direction by 8,593 to 8,593. That then being also found on the trial balance. And then we've got the cost of goods sold. It started at 380. That just being the closing out of the factory overhead to make it 0 at the end of the time period, remember? And that happened in a prior presentation. And then we're going to say that this 6,610 is going to bring the balance up to 6,990. So there's our 6,990. Here it is on the trial balance. And then we've got the finished goods. So the finished goods started at 8,736. It's going to go down by 6,610 to 2,126. That 2,126 also being found on our trial balance. So what's happened here is just basically our normal type of journal entry. Once we get these numbers, just our normal journal entry when we make a sale, as it would be if it was a merchandising company, recording an increase in sales, which increased net income. And the other side being the accounts receivable, people owing us money. We expect to get a check in the mail, hopefully. And then we recorded the cost of that inventory, bringing the net income down. So of course, the net sale is this number minus this number. That's what we really kind of net income is affected by, or gross profit, net income and gross profit by this journal entry. And then we recorded the reduction in the finished goods, just as we would in a merchandising company, reducing the inventory account for those inventory items that were sold. So if we look at our completed, worksheet here and related to our trial balance, we can still tie this information out to what we have now. So we've got our closed jobs is just going to be this 2,126. That's the only one that's still closed but not shipped, and therefore still in the finished goods. Then we have the amount that is open. That's going to be those two green ones. I can't decide where to put the calculator. It's going to be these two green ones. So it's going to be this 2390 plus the 2024. That's going to be the 4,414. That being found here. So there's the 4,414. Now again, the cost of goods sold, we can't normally track all the way through. But if we adjust the time periods and go through the cost sheets, in this case, we could say that it's the 3820 plus the 2790. It's going to be that 6610. Doesn't tie out to the 6610 here. Why? Because it's off by the under or over applied overhead that we had. That's going to be off by this 380, the under or over applied overhead. So again, the cost of goods sold isn't going to be able to tie out to our job sheet necessarily, not just because of that under or over applied overhead, but also because it's a temporary account. And we're going to have a whole lot of shipped jobs over time. As months go by, we of course will have a lot of shipped jobs. So we could try to add up the shipped jobs that were completed during a certain time period. But typically what we do here for sure is we want to support the open jobs with the work in process account, and we want to support the finished jobs with the job accounts. And so these two accounts need to be supported by job cost sheets. As we sell them, of course, we will then use these job cost sheets to determine what the cost of goods sold will be. In this presentation, we will take a look at the cost flow through the general ledger for a job cost system. If we can understand the general ledger and be able to see what is happening as the costs go through the general ledger, we really get a good idea of what a job cost system is doing and a good idea of general ledgers, T accounts, and how the double entry accounting system works. We're now going to go through this in a step-by-step process, not looking at the journal entry, but just looking at the GL and try to think about, okay, if we see the GL, the posted transactions, the posted journal entries, what is it that actually happened to make these transactions, and see the flows through the GL account. And our goal is to be able to look at really the last slide, which has all of our transactions in the GL account, and be able to see how they're all related to each other as the GL account is basically put together. So we're going to construct the GL account as we go and then look at that last slide. And if you can look at that last slide and say, okay, I see how all this stuff is basically tying together without really looking at the journal entries, then you're getting a good idea of the flows that are happening through a job cost system. So for example, this first one, we see that we have the raw materials here, and we see the work in process. These are the two things that are happening from this GL account at this time. And we can see that the raw materials is going from the work in process is going to go from 0 up by 2,230 to 2,230. And the raw materials inventory is going down, was at 150,000, going down by 2,230 to 147,770. So what happened here is that, of course, we took raw materials from, we can imagine, the warehouse, and we're putting it into the work in process account. So we can imagine a requisition form happening here in order for us to say, hey, warehouse, we need material to be taken out and put into the factory where we're going to make stuff. If it's guitars, again, we're going to take stuff out of the wood, out of the warehouse, and start to work on it in the work in process. As we do so, we put this into work in process. And remember, every time we do that, we're also supporting this number by job. We have to apply it to jobs. So then the next thing that we're going to have happen is, say, this is our next transaction. The next new thing is this item and this item. So factory overhead is going up, and the raw materials is going down from 147,770 down by 550 to 147,220. So what happened here is raw materials going down again, but it didn't go to the work in process this time. It instead went to factory overhead. Why? Because we didn't know which job to put it to. This might be small stuff. It might be glue on the guitar. It might be small components on the guitar, where the factory just went into the warehouse and said, hey, I just need glue. I don't know which job we're going to work on. We're going to put it in the middle of the factory and use it for like all the jobs. Well, then we're going to have to just put it into factory overhead because we don't know which job. We'll assign it out later. So this is indirect materials here. So then the next thing that happens is work in process here and wages payable. Okay, so wages payable and work in process. Wages payable is a liability account. It went from 0 up in the credit direction to 4,200. The other side going to work in process. So this one's a little bit more confusing for most people because you can think of it, it's kind of like we process payroll, what happened here. And instead of crediting cash, we haven't paid it yet, so we credited wages payable. And instead of debiting wages expense, as you would think, we debited work in process. Now, that's confusing for a couple different reasons because obviously we're not dealing with withholdings or payroll taxes and that stuff. And one, and two, because most people, think of a journal entry that should be the debit should be going to wages expense. And that's the thing we got to kind of unlearn. A lot of these things that we think of as just expenses because of what they are really expenses because of the period that they are being incurred in. In other words, these wages expenses are not being incurred in this time period to generate revenue, but to generate an asset, inventory. So instead of debiting wages expense, we're putting it into this work in process. As we do so, the work in process is going up from 2,230 from the direct materials, up by the 4,200 for the wages to 6,430. And we're also going to have to post that to the job. It's direct Therefore, we know exactly which jobs were worked on by this 4,200, and we'll be posting to the job sheets as well. The job sheets then, if we add them all up, should add up to the 6,430. Next thing that happens, wages, again, we're crediting it, but this time not debiting work in process, but factory overhead. Same thing, we're kind of like thinking like we're processing payroll. Instead of crediting cash, we're crediting wages payable because we haven't paid it yet, liability account, bringing the liability up from 4,200 by 1,200 to 5,400. The debit not going to wages expense, not going to work in process as it did before, but going to factory overhead because it is going to a job. I mean, it is going to inventory, but we don't know which job. So it's not expensed because it's not helping us generate revenue now. It's part of inventory, but it's not part of work in process because I don't know which jobs to apply it to. Instead, it's going to go into this bucket of factory overhead. It's going to be indirect labor, stuff like on, the supervisor salary, the maintenance in the warehouse, anything wages related that we couldn't apply to a job. Next thing that happens is we're going to say that we credited accumulated depreciation and debited factory overhead. Why would that happen? Well, accumulated depreciation is related to equipment. We know that journal entry always has a credit to accumulated depreciation, it being a contra asset account. It's going in a credit direction, 153,000 credit up in a credit direction by 2,500 to 155,500. The debit then is not going to depreciation expense as we would normally expect, but is going into factory overhead. Why? Because it's depreciation on factory equipment, and it's not helping us to generate revenue. And we didn't put it, so it's got to go into inventory. We didn't put it into work in process because we don't know which job to put it to, and therefore we had to put it into this bucket again, this factory overhead. Next thing that happened is that factory overhead increased and we credited cash. Now note that this journal entry doesn't tell us a lot of detail. We don't know exactly what we paid the cash for because the factory overhead doesn't really define that. What we do know, however, is that whatever we paid for it was probably something on the factory because cash is decreasing and it's going into factory overhead. So it should have been part of inventory. So things like utilities on the factory, insurance on the factory, anything that's on the factory that we couldn't apply to a particular job, we're just going to dump into this factory overhead bucket. Next thing that happens is factory overhead goes down and work in process goes up, meaning work in process was at 6,430. It's going up by 6,720 to 13,150. Factory overhead was at 7,100. It's going down by 6,720 to 380. Now these are both kind of asset accounts. They're both kind of inventory accounts. This inventory account is going down. We're putting it into work in process. Why? Well, the factory overhead, we really wanted it in work in process the whole time, but we couldn't do so. What was stopping us from applying these directly out to work in process? We didn't know which job to apply them to. Now we must have figured that out. We figured out how to apply them to a job, and we just used an estimate. So we used some type of estimate to say, I know which job to apply this amount to, so I can support this amount on job cost sheets and therefore apply it to the work in process account. So now the work in process account is here. It includes direct materials, direct labor, and overhead. And all of these numbers can be broken out and supported by job cost sheets. Next thing that happens is factory overhead is going to zero. It had 380 in it. We credited it by that exact amount, making it go to zero. Cost of goods sold went from zero up by 380 to 380. Why would that happen? Well, the factory overhead, really never gets to zero unless we force it to do so, because it's only an estimate. Remember that these items represent indirect labor, indirect material, anything else on the factory that we couldn't apply to an actual job. And these are actual costs. And then we applied it out to the jobs using an estimate, which means that they're never going to be exact. Those two things are never going to be exact. Either it will be under or over applied. This happened to be under applied because we applied less here than the actual costs. And therefore we had to close this out, and the other side went to cost of goods sold. This just being kind of like what we had to do. Doesn't have anything to do with the actual cost of goods sold. It's just an estimate. It being small and therefore not affecting our decision making. So not material. That's why we can do it, even though we don't exactly know exactly what happened, because it's just an estimate that we're trying to clear out this estimate so that next period we can start at 0. Next thing that happens, we see that the work in process is going down from 13,150 down by 8,736 to 4,414. Finished goods is going from 0 up by 8,736 to 8,736. These are two basically inventory accounts. They're two asset accounts. One is going down, one is going up. What is happening here? Well, this is work in process, meaning the jobs are still in process. These are finished process jobs. That means whatever, some jobs must have been completed. We took them out of the in process account and put them into finished goods account. And so these two numbers then are going to be supported by job cost sheets. We counted up those job cost sheets for which jobs have been completed and then transferred them from work in process to finished goods. So this number then can be supported by job cost sheets. What's still left in work in process should be able to be supported by job cost sheets. Next thing that happens is we debit accounts receivable, bringing it up from 180,000 by 8,593 to 188,593. We see that the revenue is the other side of that. These two are the same number. It's going from 0 up by a credit to 8,005 up by a credit of 8,593 to 8,593. And then we see cost of goods sold is going from 380 up by 6,610 to 6,990. And finished goods finally is going from 8,736 down by 6,610 to 2,126. So there's a lot going on here. There's two journal entries happening. And why would we combine those in one slide? Because that's the normal sales journal entry. So we're recording the sale of our inventory. The sales here is going up, and the related account to that is accounts receivable. We made a sale and accounts receivable goes up. These two, although they're usually the thing we focus on in practice, are confusing here a little bit because they're not where our focus on is here. Our focus on through this entire process has been on the inventory, which means finished goods inventory has now been completed and shipped and is going down from 8,736 down by 6,610 to 2,126. And the other side of that is not sales, but cost of goods sold, the expense account, the expense of us, our inventory, which is the same as a merchandising company, where this is a same transaction that you would see for a merchandising company that's just selling inventory, except they wouldn't have finished goods inventory. They would just have inventory. So it's going to go from 380 up by that 6,610 to 6,990. The other side, sales going up and accounts receivable going up, is the other side of just the sales journal entry, but it has nothing to do with really the numbers we've been tracking here. If you want to tie this number into all the other numbers or how we got it from the job cost system, you can't unless we use the job cost sheets to derive the sales number, which may happen, but it's not necessarily the case. The sales number is not tied necessarily to the job cost sheet unless that's how we create the sales number. So now if you want to take a look at the final sheet here, if you can kind of go through this and see how all these are related, if you go through this and basically tick and tie out the numbers that we have from just the end result here, you'll have a good idea of what is going on. So for example, if you can go through here and say, okay, here's the work in process account, here's the raw materials account, and maybe even tie these out. Here's a 1 and a 1 on that one. Next thing that happened, so that's work in process that we tied out directly. Next thing that happened is a 2, raw materials went down here, and that went to factory overhead. And that's happened because this is indirect labor or indirect materials that went to factory overhead. And so you can kind of tie those things out. 3, what happened is this account here, wages payable, is going to work in process because we applied that out to work in process. And then 4, what happened, this wages payable is going to factory overhead 4 because that is going to be indirect labor. And so if you just keep on going through that process and you can see the flow through here and see how it all ties together within the GL accounts, then that's a good practice to do, because it gives you good information, again, just of the flow of a job cost system. And it also gives you just a good working with, like, these are basically T accounts, GL accounts, and just getting a good idea of debits and credits and how debits and credits are flowing through the T accounts. Hello, in this lecture we're going to talk about a job cost system. At the end of this, we will be able to list accounts related to inventory in a job cost system, explain what a job report is and why it is needed, journalize transactions related to inventory in the job cost system. Alright, so first we're going to take a look at a list of accounts and break out the items that we will be working with. Then we'll go through an example to demonstrate this. We have the trial balance. Trial balance is going to have the debits that are non-bracketed, credits have brackets, therefore the debits minus the credits will equal 0. That's showing us that we are in balance. No income at this time. The green accounts are assets, the orange accounts are liabilities, equity in the light blue, income in the dark blue. Net income is, of course, these accounts down here. We will be focusing in on the inventory type accounts when we are talking about the job cost system. Those accounts including raw materials that will be going into inventory, work in process, the work that's in process that will be inventory once it's done being in process. At that point, it will then go into finished goods because it's finished. And then we have this overhead. This is this bucket. I'm going to put it up here in the assets section because it will be an asset at the end of the day. We're going to put the miscellaneous information that can't be applied specifically to a job here and then apply it to the job based on some type of ratio or estimate. Now, we then have the general ledger account. Obviously, every account has a GL account listed by date. We won't list every account here. We will focus in on the accounts that will be related to inventory, raw materials, going into work in process generally, factory overhead, the stuff that will then go into work in process as well once we allocate it out, and the finished goods will then be here. Those are the asset accounts related to inventory that we're going to focus in on. Remember, work in process, what it's going to end up consisting of is the inventory, which is going to be raw, direct materials, direct labor, factory overhead. So when you think of inventory, you always want to think that if you're a manufacturing company, we're going to actually do that in the process. It's going to have direct labor, direct materials, and factory overhead. If we just bought the inventory, you can think of it the same thing is still there. What made the inventory was labor, overhead, and direct materials. That's what's in the inventory. And then we've got the job cost record. So this is going to list it out by jobs. So remember, when we talk about jobs, all the jobs are different. So I often think about construction because construction could have very different jobs, and I've worked in construction. But any job that is different in nature, we want to break out by job so that we can allocate the items to the job. So we have direct material, labor, and overhead that we're going to allocate to the jobs. And you might be thinking, this looks kind of like an invoice, and it is kind of like the items that we would put into an invoice if we were to bill a client for, say, a job. Of course, we would then have to mark it up for what we were going to get for it, for our time, on top of these items, which are just the costs. These are just the costs to us, not counting up any markup for our revenue. So if you think about this as an invoice, this is the material that could go into an invoice, and then we'd have to mark it up. So if we look at our jobs, we got job 14 and then 15 down here for some reason, and then 16. And if we add those three jobs up, we got the 41,000, the 0, and the 42 adds up to this 83. That, of course, ties out to the 83 on the trial balance. That, of course, also ties out to the 83 in the work in process. So that will always be the case. We need this to back up the work in process in a similar fashion as we need like an accounts receivable subsidiary ledger to back up the accounts receivable account. Why? Because the general ledger doesn't tell us the whole story. It only breaks it out by date. We need to break it out in the case of the receivable by customer, who owes us money. And we need to break it out in the case of work in process by job, which jobs are making up that amount. Because when we transfer or sell those jobs, we need to know the costs related to that particular job that was sold. Alright, so we're going to go through some transactions and work through these. We got purchase raw materials of $400,000 on account. So if we purchase raw materials on account, then raw materials is going to go up. So here's the raw materials account, a debit. We're going to make go up with a debit. And the accounts payable went up here with a credit. It has a credit balance that went up. Now we're going to focus in on the raw materials, of course, because that's going to be our asset account. So now we have the 150 goes up by 400 to the 550. That's what our raw materials is at this point. Of course, accounts payable went up as well. We're not going to look at the GL account because that's nothing new to us. That's a normal process within our accounting. And if we look at our job cost report, nothing new happened here because this raw materials here is not yet into any particular job. So you can think of it as just a pile in the corner, hasn't yet been applied to the job, therefore it's not in work in process, therefore it's not going to be applied to the job until we request it to be applied to the job. So now we're going to say, okay, now the first thing that happens is we are going to take that raw material and requisition it to the particular jobs. So job 14, 15, and 16 requested raw materials in this fashion. So if we add those up, then it adds up to 350. So work in process here is going up by 350, and it's coming out of the raw materials. So if we look at the general ledger, we're going to say, okay, raw materials is going up by 350. Raw materials is going down by the 350. 550,000 in it minus the 350 to 200,000, and it's going into work in process representing our jobs. So it went up from 83 by the 350,000 to 433, but this 350,000 represents all three allocations to all three jobs. It's not broken out for us in the general ledger, or of course in the trial balance. That ties out to the trial balance, but I don't know which job, if I sold those jobs, what is it related to? Therefore, we need to allocate it to the jobs. Here's the materials. Here's job 14 with 100. It's at 114 in terms of materials, labor, and then overhead adds up to total job of 141. Job 16, we're jumping down to 16, 80,000. Here's the 80,000, and that's a total job at this point of the 80,000. And then job 15, 170,000, bringing materials up to 188, plus the labor and the overhead 212. If we add up these three jobs, 141, 80, and 212, we get to 433. That ties out to the 433 on the general ledger. That ties out to the 433 on the trial balance, of course. All right, next transaction, direct labor. All right, so remember, we have direct labor broken out by job now. We're able to apply the direct labor specifically to each job. We know the jobs that happened. So the journal entry related to labor is going to be debit to work in process and a credit to cash, we're going to say. Now, when we think about labor, it's a little bit confusing because when we think about labor, we think about processing payroll. We're processing payroll. Well, for one, we're taking out the payroll liability and whatnot because we're simplifying this transaction. We don't want to complicate things by thinking about payroll. But this is basically a payroll transaction. We're crediting cash because people earned money. And we're debiting, you would normally think, wages expense, because that's what we've probably done in the past, some kind of expense related to wages. That's because we used it in order to generate revenue in that time period. In this case, it's not an expense. It's going to be part of the asset because we used their work to make the asset. So a lot of things that were expenses before are now part of the asset, and we've got to change our way of thinking for that reason. It's part of the accrual process, but many people just start to memorize what type of transactions are expenses, and wages usually just falls into that category, and we don't train ourselves to think, well, that's because of the matching principle and that we use the wages to help us generate revenue, and now it's not part of the matching principle because now we're using those in order to generate the asset. So we're going to have to rethink a few things here. So we put in now this direct labor into the work in process at the 218. Remember that, again, we combined all these to one number, 218, and that is now the ending balance in the work in process is the 651, but we need to know how it is by job again. So that 651 is not enough. We want to know how it is by job. So if we actually sold the job, we would know. So if we allocate this out, 30,000 to job 14 brings it to 48. Plus the materials, plus the overhead brings it to 171. The 120 here brings it to 120. So the 80 plus the 120, total job 200,000. The 68,000 to job 15. So the 188 plus the 84 and the 8 gives us the 280. So if we add up the three jobs, the 171, the 200, the 280, we come up to the 651, which of course ties out to the work in process on the trial balance, which ties out to the work in process on the general ledger. Next transaction, applied factory overhead based on a predetermined overhead rate. Now we'll talk about a predetermined overhead rate at a different time. This problem we're just going to give the predetermined overhead rate. Why? What is the predetermined overhead rate? Well, remember that factory overhead is going to have all the stuff that we're going to put into factory overhead that we could not apply directly to a job. Things like the supervisor salary, things like depreciation on the factory, things like small materials like grout or something, that it would just be too costly for us to track how much of it went to a particular job, but we do want to put it into the job somehow. So you might think, well, we could just allocate that evenly to each job. How many jobs? Let's just estimate it out and allocate it evenly. But the jobs are different in nature, remember. So the jobs are different sizes. So we have to figure out, okay, how can we allocate this stuff to the jobs using some kind of relevant allocation method. And so what we do is we usually find a cost driver, and oftentimes that's going to be direct labor. So why? Because direct labor, jobs that have more direct labor, they would then have more cost allocated to them. They would be larger, so you would think we would allocate more overhead. So we determined, based on last year's numbers, based on the ratio of direct labor compared to the overhead, how much we should allocate to each job of overhead based on how much direct labor was in each job. We came out to 50%. Now, if we do the journal entry, then we're gonna say the job's gonna get work in process 109 into work in process. We're gonna credit factory overhead. So again, that 109 represents a bunch of different stuff that we're just kind of allocating in based on last year's numbers of all this kind of stuff that we just allocated out that we're going to put into factory overhead. Based on last year's numbers of all this kind of stuff that we just allocated out that we're going to put into factory overhead. And I want to point out also that note that the factory overhead before this had nothing in it. And that's just to point out that we could do this allocation. That's why we base it on last year's numbers, and that's why it's an estimate, because we want to be able to allocate it out before maybe there's even stuff in the factory overhead, because it's going to even out at the end of the time period, and we'll have to make an adjustment for it. So that's why we have to make the estimate kind of based on last year's numbers. We actually have negative factory overhead. We allocated stuff out before we recorded the factory overhead in this case. And so now we have a negative factory overhead, kind of like negative inventory. We're going to put the stuff in the factory overhead in the next few journal entries, and then we will end up with something close, hopefully, to 0. It should go into factory overhead and then out of factory overhead. Or in this case, out of factory overhead and then into factory overhead. But so it should even out by the end of the time period. And so we're putting it in there, and then the other side is going in here into work in process. So we're putting it into work in process. Here's work in process. What's in work in process now? Remember, this was direct labor. This was direct material. This was direct labor. This is factory overhead. And we're going to have to then allocate that, of course, to the job because we hit the work in process. We need to back this number out by job. Here's how we're going to back it up over here. Now, how we calculating this, we're saying direct labor. So in this case, direct labor total was this 218 we did last time. 218 times 0.5. That's how we're coming up with the 109 total. If we want to break it out by job, then we're just going to say, okay, here's the direct labor, the 30,000 times 0.5. That's our 15 for job 14. And then we're doing the same thing here, the 120 times 0.5. That's the 60,000 here. And then the 68,000 here, 68,000 times 0.5. That's the 34,000. Now remember, these numbers don't have anything to do with labor, but we used labor in order to see how big each of these jobs are relative to each other. So you notice that this one had labor of 120, the rationale being that we should allocate more to this job based on the fact that direct labor is higher, because that would indicate that it's a bigger job. Therefore, we allocated more overhead, 60 to here compared to 15, which had much less direct labor. These two aren't directly related. This direct labor indicates the size of the job and therefore the allocation method for the factory overhead. All right, so next time, indirect labor paid and assigned to the factory. All right, indirect labor. So we're going to debit factory overhead, we're going to credit cash. These are going to be the types of things that we're going to have to put into factory overhead, which we already allocated out before. So the factory overhead, indirect labor, once again, we're going to think about payroll here. This is payroll happening. We're not thinking about payroll taxes. We're debiting, instead of payroll expense again, we're debiting factory overhead because it's going into the asset. Last time we debited factory overhead for payroll for the direct labor, And the difference here is that we don't know which job these guys worked on specifically. It might be the supervisors or something that kind of supervised all the jobs, or maybe we don't know what they did really, but we need to apply it to the job somehow. So therefore we're going to put it into factory overhead and then allocate it out using that allocation method we did last time. So we already allocated it out, see, and now we're putting it in, this 14,000 into factory overhead. No effect in this case on the job cost, because when we put it into factory overhead, we haven't yet applied it to the job. We haven't put it into work in process. That's the whole point of us putting it into factory overhead. I don't know which job to put it into, therefore we couldn't put it into work in process. We're going to allocate it out as best we can using some kind of ratio. All right, and of course the total here still ties out to the total there and the total there. And next thing that happens, amounts applied to factory overhead. So here's all the other stuff that can kind of be in factory overhead. We got the indirect materials, we've got the factory utilities, the factory rent, the depreciation. These are all things that on the factory, anytime something says on the factory, that means it's going into inventory. That's part of the inventory process. And either we can apply it directly to the job, which means we'd put it into work in process, or we can't in this case. Therefore, it's going into factory overhead. So the journal entries related to this then would be materials. We're going to debit factory overhead, the 14,000, factory overhead for the 30,000. That's this item here, because we did the 14 last time. And then we're going to credit raw materials inventory. It's coming out of the raw materials up here. And we can also see that right there. All right, and so these are going to be things that we couldn't apply direct, like glue or something like that, types of material we couldn't apply directly to the job. Then we got utilities, so we're going to debit the factory overhead for the 12, here it is there, and we're going to credit cash. This is another one that if you think of utilities, you probably think utilities expense. And so what are you doing debiting the factory overhead? Because it's utilities on the factory, and therefore it's part of the inventory, and we have to capitalize it. So it is in accordance with the accrual matching principle, but you may have just memorized that utilities should be debiting the utilities expense, so you got to unlearn that. And then next we have the rent, 20,000 to factory overhead. Here's the 20,000. We're going to credit cash again for paying the rent. And this is another one. You probably think rent expense, right? Why are we debiting factory overhead? And again, same thing. Well, it's rent on the factory where we make inventory. Therefore, we have to put it into the cost of the inventory. And then we have the depreciation on the equipment, 30,000 debit. Here it is in the factory overhead. And credit accumulated depreciation. Once again, you're probably thinking, how do we record depreciation expense since the beginning of time? Debit depreciation expense, credit accumulated. Well, we're not having an expense. We're putting it into the factory overhead because it's depreciation on the factory. So remember, we already allocated out of the factory this 109. This is all the stuff that we allocated here. And so the 109 minus all the debits means that we're off. Our allocation was out of balance by the 3,000. That's okay. That's an estimate. We're going to have to deal with that, though, at the end here. All right, so now we transfer jobs from work in process to finished goods. So now we have work in process here, the 260. We're done with some of that stuff. So we're going to take it out of there and put it into the finished goods. So here's our job cost. So we transferred 14 and 15. So here's 14, here's 15. We're going to say it's not open anymore. It's now closed. It's now closed. So if we take out the calculator here, we're going to say that the two jobs that we have are this 186,000 plus the 314,000. Those got allocated out 500,000. Those are allocated out. What's left, just the yellow account of 260. 260, that's what's going to be left in work in process. This and this are going to be allocated out to the 500. How do we do that with a journal entry? We're going to debit the finished goods, 500,000, putting it into 500, and we're going to take it out of work in process. If we look at the general ledger account, what's happening, it's going into finished goods, debit finished goods, 500,000, that's where this number came from. Crediting work in process was at 760,000 minus the 500 credit, brings it to 260. There's the 260. These need to be backed up by the job cost report as they are here. All right, so we're still tied out there. And next item, now we're going to sell. So now we've got stuff in finished goods, and we're going to sell it, meaning it's going to move to cost of goods sold. Now the confusing thing when we sell something, we sold job 14, and they give us a sales price. When we think about a job cost system, the sales price can actually throw us off because we haven't been thinking about the sales price at all. We've been thinking about the cost the whole way through. This sales price has nothing to do with our job cost report. We may have gotten to the sales price by using the job cost report, but the book is usually going to give us a sales price, and we're going to record the same journal entry we would if it was just a service company, or at least the first half of it's going to be the same. Meaning we're going to debit, in this case, the cash, $380, and we're going to credit sales. So that's just, we got $380,000 cash. We're going to credit sales. Now, where did we come up with the 380? The book's going to have to give it. We did some kind of markup. They didn't tell us that, right? We came up with the sales price. What we do know, though, is job 14 was sold. Here's job 14. It's no longer closed. It's shipped. It's gone. It's out. And it had a cost of the 186. So what's going to happen? This finished goods, we're going to have to give it up, crediting the 186, and we're going to have to put it into the cost of goods sold. So we're going to debit cost of goods sold, the expense related to the asset that we sold, and we're going to credit the finished goods, taking it out of finished goods. So in terms of our asset accounts, the finished goods is going to go from the 500 down by the 186 to the 314. So here's the 314 there, here's the 314 here, and of course, and here's going to be the 314 here, represented by the job that has been closed but has not yet been shipped out. It's going to be in the finished goods. So if we recap this, then we can see that the 260,000 will be in the job cost. That represents the job that's still open, the job that we're representing with the yellow item. It's going to be still open, still in the job cost. That's backing up the work in process account. Now, the job cost system is also going to have jobs that have completed and have gone through the process. So we have this job 15 that has closed but has not yet been shipped. That's going to be the 314. That's what's going to be in the finished goods here. That's in the finished goods, and that's in the finished goods on the trial balance. And then, of course, we have the job that has been shipped out. So this job's been completed, been shipped out. We've represented that by highlighting the shipped area. That's going to be the 186,000. And that's going to be what the cost of goods sold is representing at this point because it has been shipped out and therefore expensed. All right, so then we have the last piece. We got the adjust for underappreciated or overappreciated factory overhead. So what are we talking about here? If we look at the factory overhead, remember last time we left off with this 3,000 credit in factory overhead. We applied out 109,000 to our jobs, and then we put all of this stuff that makes up the factory overhead, and our estimate was off by the 3,000. We need to make that go to zero because we want to basically have a zero at the end of this time period so that we can make a new estimate next time period. So we just need to make that zero. So how do we make it zero? That's a credit. Therefore, we're going to do the opposite thing to it and debit it, making it go down. Where are we going to put the other side? Easiest thing to do, put it into cost of goods sold, crediting cost of goods sold. Now you might be saying, well, that's kind of funny because cost of goods sold is a debit balance and it's an expense account. Why would we be crediting it? We don't normally credit cost of goods sold. And the reason is because it's a small amount. Hopefully it's in material. We're doing this because the estimate was off. It's going to be off because it's an estimate. And we need to take it down somewhere. If it's in material, then taking it to cost of goods sold is the easiest thing to do because cost of goods sold is something that will then close out to retained earnings. Unlike some of the permanent accounts, all the permanent accounts which would not close out. Therefore, once it closes out to retained earnings, it'll be gone, and that'll allow us to basically make a new estimate next time from scratch, from fresh start. So that's going to be the idea. Now, if it was significant, if it's a large amount, then we may have to do something else. But if it's insignificant, meaning it's not going to affect our decision making, then it would seem appropriate to just put it to cost of goods sold, that being the easiest thing to do. Also, just note that if we happen to have gone the other way, meaning that we ended up with a debit of like 3,000, we would do the same thing. We would make it go to zero. We're going to do whatever we need to do to make it go to zero. And in this case, that would be a credit to make it go to zero. And then we would debit cost of goods sold, once again doing whatever we need to do to make it go to zero as long as it's an immaterial amount. No effect on the job cost system of this. We still have the 260 tying out to the 260 because the factory overhead, we're just dealing with the factory overhead, not the work in process, not the finished goods at that point.